Hello, everyone. Welcome to this first workshop jointly hosted between the Climate Impact Lab and the Federal Reserve Bank of San Francisco. My name is Hsiang, and I'm at UC Berkeley. I'm also one of the co-directors of the Climate Impact Lab. And I'm just gonna try to get us started today. We have a great schedule ahead of us. So I have the schedule here, and I also want to give a few reminders about the conference today. So first of all, the conference this morning is being recorded, and the audience is muted and invisible by default. You'll only see the participants on the screen, but we do welcome audience questions throughout the event, and you can submit them using the Q&A function in Zoom, and we'll work as quickly and diligently as we can to get them answered throughout the day. The schedule for today is quite exciting. Rudebusch from the Federal Reserve Bank is going to open us up, describing the perspective of climate change regulation from the Fed. Then we'll have a panel on macroeconomic risks in the US, another exciting panel on regional climate risks, looking at flooding, drought, and wildfires. We'll have a short break, then we'll have a keynote by Bob Litterman. And later in the morning, we'll have a panel moderated by Glenn on managing physical risk in the US financial system. Then we'll have another short break, and we'll have some keynotes from guests from Capitol Hill, Senator Schatz, and Republican Senator Patrick McHenry. Trevor will moderate that discussion, and Michael Greenstone will be providing closing remarks shortly after, just before 1 Pacific time. So just to get us started, I thought I'd give you a few thoughts just on my own about sort of how I come at this problem. Thinking about climate change and the stability of society is something that we have done and many other historians have done for some time. If you look throughout deep time, we see lots of episodes where societies around the world have faced major periods of instability and collapse when the climate has changed. And it's been something that human societies have struggled with for quite some time. Right now, the climate is changing, and events like Hurricane Maria have been totally unprecedented in the historical record. And these types of extremes have had fundamental impacts on the economy. By some of our calculations, we estimate that Hurricane Maria, for example, set Puerto Rico back almost over 20 years in just a matter of hours. And so the scale of these events have impacts similar to other major financial crises that we are often expected to think seriously about as economists and regulators will need to manage. To put perspective on other more subtle effects of climate change, we at the Climate Impact Lab have done some calculations about summertime temperatures across the United States. And I think it's often not clear to people exactly how fundamental this change will be to the country. So for example, here's a graph showing summertime temperatures for states in the United States in a high emission scenario versus what's been historical. And so summertime temperatures in Maine, one might expect by end of century to be similar to those currently experienced in Virginia. Or in other cases, summertime temperatures in Connecticut might look more like summertime temperatures in Arizona or Georgia today, historically. Whereas in Ohio or California and New Jersey, it might feel a little bit like Louisiana and Texas. And then in a whole host of states, we're talking about summertime temperatures that don't look like anything we've seen in this country to date. And so we're talking about moving into a completely new climatic regime for this country. You can think about the costs and the impact on society of these climate changes a few different ways. So one way to do it is to think about it as an input into many different aspects of human well-being, about human health, agriculture. This is a graph in which we tried to calculate some of those impacts across the country. We call this the bottom-up approach, and it takes as inputs results from many of the speakers today, actually, like Michael and Wolfram have all done studies that have contributed to estimating these impacts at small locations around the country. You can try and add these up using a bottom-up approach. An alternative approach that many of our speakers will be talking about is a top-down approach, looking at the country from above, looking at the economy, sort of using GDP-like statistics while you're looking at countries around the globe or counties in the United States. We see that changes in temperatures on a daily basis have impacts on overall productivity in a very meaningful way. To put this in perspective and where we are in the field today and in the longer arc of history, I really like this slide. I often point out that the history of governance around the world has been fundamentally altered by major technological advances in the technology of governance. Whether it's like written law in the Code of Hammurabi, or just the notion that everyone should be treated equally before the law, and the institutions of international governance that the last century has seen blossom around the world. We are right now in the very middle of a very exciting another revolution where data science is playing a huge role in how we think about managing ourselves and how we see the decisions before us. And climate change and also the management of COVID-19 are excellent examples of how important this has been for us. You can see this in action and the progression of how this has played a role in thinking. Back economist, Ellsworth Huntington was publishing in the QJE in 1917 about the role of climate change in historical development of societies around the world, including this paper on Rome. Bill Nordhaus wrote an extremely influential series of papers in the early 90s. Here's the science paper in which he introduced the DICE model to the world. And that helped us think theoretically about how we might manage the climate as if it were an element of capital for the global economy, and how we might invest in it and think about intertemporal trade-offs. Now, these sort of historical accounts and theoretical models have been very useful for shaping our thinking, but they didn't provide us with the detail or the precision or the quantified metrics we might need to institute sort of concrete regulations. And so now the entire field has been moving in the direction of leveraging sort of cutting edge data science, linking it to econometrics, and tying it all down with theory. And so, for example, just here's a graph from the work of the Climate Impact Lab on future mortality risks around the world. Our team and other teams have been trying to leverage sort of the full power of modern computing systems to help us better understand and see what the future might look like, and help regulators provide glean insights that will help them do their job and support well-being around the world. So just to wrap up, here's a figure I think is useful for us to, contemplate the choices before us. On the left, you have temperatures around the world in a high emission scenario, and on the right, you have temperatures in a high mitigation scenario. The night lights of the human populations underneath have been rescaled to reflect simulations of economic growth. And it allows us to sort of think about the linkages between society and climate and the economy, and will help us think through what other types of decisions we want to make and the world we want to leave. I often point out to people in this arc of thinking about how decision makers have moved societies forward. In the past, leaders didn't really know, what was coming, and they would have to turn to fortune tellers or look at the stars to try and sort of get a sense of what was coming ahead or how their decisions might impact their society. Today, we don't have to do that anymore. We have science, we have computers, we have new statistical techniques. We have the ability to really see forward and make better decisions. And so, I'm very excited for today's workshop. Today we'll be hearing from many of those scientific leaders in the community. And hopefully it will all help us get our heads around the problem of how do we regulate this question and move the ball forward. So with that, I'd like to introduce Glenn Rudebusch, who's the Executive Vice President and Senior Policy Advisor of the Economic Research and Development at the Federal Reserve Bank of San Francisco. Glenn hosts the virtual seminar on climate economics, which is a great online seminar for research on the economics of climate change. I encourage you all to attend. It draws from macroeconomics, microeconomics, finance, econometrics, and environmental economics. And today, I'm going to pass it to Glenn as he's going to share with us the Federal Reserve Bank's perspective on climate risk. Thanks a lot, Glenn.
Thank you, Saul. It's a pleasure to participate in this conference. I'm going to talk about the role of a perspective on climate change from the Federal Reserve, in particular on supervision, financial supervision. Over the past 5 years, central banks and financial supervisors around the world have increasingly emphasized the importance of accounting for the economic and financial impacts of climate change. So this conference couldn't be timelier. Climate change increases the likelihood of shocks and disruptions to the economy, as Saul just described. This results in greater risks for financial institutions' balance sheets, for credit availability, and for the stability of the financial system. Financial supervisors are starting to grapple with these threats, but these are early days, and we need a much better understanding of how climate change affects financial markets, financial asset classes, and financial institutions. Today, I'll describe how the general economics research community can contribute to this better understanding. Before proceeding, I should note that I'm only speaking for myself, and these remarks do not necessarily reflect the views of anyone else within the Federal Reserve System. To start, let me note that at a broad level, there are 4 sources of climate uncertainty. First, the future path of carbon emissions is unknown. That path depends on climate policies, economic growth, and technological innovation in the years ahead. Second, for a given path of emissions, the extent of the resulting climate change is uncertain. There are worrisome point estimates and central tendencies for that climate change, but scientists have also highlighted tail risks of even more severe climate tipping points. Third, given a climate outcome, there remains considerable uncertainty about the amount of damage to the economy and the associated financial repercussions. This is true despite the remarkable advances by the Climate Impact Lab that Saul just mentioned in this area. Finally, there's an uncertain feedback loop from those policy, economic, and financial outcomes back to the path of carbon emissions. Of course, anything that researchers can do to help understand any of these links and quantify the uncertainties will assist financial risk managers. But I also want to provide more specific guidance to researchers, and that requires being a bit more precise about what financial supervisors do. Financial supervision operates on 2 levels. First, there is microprudential oversight of the risk management procedures of individual financial institutions. Those institutions should have in place the right governance, the right models, the available data sources to assess credit risk, market risk, and operational risk, among others. So that's at the micro level. Second, there's a macroprudential oversight undertaken of the channels of risk management, risk that could threaten the stability and functioning of the overall financial system. The importance of this holistic approach was emphasized by the interconnected risk management failures during the global financial crisis. Climate risk is relevant for both types of prudential supervision, micro and macroprudential. Indeed, just a few weeks ago, the Federal Reserve published 2 reports, a supervision and regulation report and a financial stability report, that provided a 2-pronged official acknowledgement of the importance of climate change for financial oversight. First, at a microprudential level, the reports noted a supervisory expectation that individual financial institutions should monitor all of their material risks, which for many banks are likely to extend to climate risks. Second, at a macroprudential level, the report noted that the Federal Reserve will monitor and assess the financial system for vulnerabilities related to climate change through its financial stability network. I'm going to drill down to illuminate how further research could assist federal financial regulators on each of these 2 supervisory roles, microprudential and macroprudential. As a concrete example, a literally concrete example, consider real estate. Property assets and property markets have potential exposure to a wide variety of physical climate hazards, including storm surges, wildfires, hurricanes, rising sea levels, and increased temperatures. They may also be exposed to transition risks, such as climate-related policy shifts, say in building codes or insurance rules, but I'll focus on the physical risks. As a result of climate-related physical risks on real estate, Individual financial institutions face the potential for credit or collateral losses as the property supporting loans is destroyed or becomes less productive. Financial institutions also face potential losses in the market value of impaired property assets. Finally, financial institutions face physical risks to their own operations because of acute climate events that can close or damage offices and data centers. In this way, climate change can affect financial institutions through the traditional microeconomic risk categories of credit risk, market risk, and operational risk. Just as there are microprudential concerns, there are broad macroprudential concerns as well from climate-related real estate risk. Losses, especially correlated losses, could lead to sudden shifts in investor risk perceptions and abrupt repricing of real estate loans, mortgage-backed securities, and related assets. Just as the subprime mortgage sector triggered a larger financial crisis, real estate assets with climate-related risks could pose a larger systemic financial threat. Correlated losses, say from widespread flooding or wildfire, could create vulnerabilities for financial stability. These vulnerabilities are exacerbated by the opacity of climate risk, as it is difficult to gauge which real estate assets are at jeopardy to climate risk. Given these micro and macroprudential concerns, what additional analytics and research could assist financial institutions and financial regulators to better assess climate physical risk? In particular, how can economists help? From a microprudential perspective, financial institutions are struggling to understand the transmission mechanism that links physical climate risk to balance sheet risk. For banks, so-called climate scenario analysis can help identify lending portfolio sensitivity to physical risks. Economists can help model this mechanism by correlating physical climate measures with economic variables and financial losses. There are many challenges to doing such analysis, including the long time horizon, potential shifts in the correlations relative to historical patterns, and the lack of asset-specific, geographically granular data sets. The last of these, the data requirements, cannot be overestimated. Large amounts of information are required for climate scenario analysis. For example, to assess the climate physical risk to the value of corporate debt requires understanding the vulnerabilities of various physical locations, supply chains, and buyers. Namely, how might disruptions in ground transportation, shipping, or power grids affect a business's revenue stream and costs and its ability to repay loans? As well as this granular applied microeconomic analysis, there's also an important role for financial economists to supply a better understanding of the finance of climate risk. Understanding how climate-related losses affect financial markets and institutions depends on who holds the relevant assets and their risk management and loss-absorbing capabilities. Furthermore, assessing the role of derivatives to hedge this physical climate risk is another important adjunct analysis. Turning to macroprudential risk, an important regulatory tool for assessing macroprudential risk is stress testing. The Federal Reserve stress tests large bank holding companies to assess their capital adequacy to weather adverse macroeconomic conditions. Some regulators in other countries are experimenting with macroprudential climate risk stress testing, notably in Britain, Canada, France, and the European Union. That is, they're applying what has been a stress test for adverse macroeconomic condition to consider a stress test for adverse climate conditions. These climate stress tests are preliminary attempts to understand how climate risks could propagate across the non-financial economy and the financial system. And to improve future climate stress tests, there are opportunities for economic researchers of various disciplines. Modeling the interactions among climate, the macroeconomy, and the financial sector will require a handshake between the current integrated assessment models of the climate and the economy, as well as macro finance models that can calibrate financial sector exposure. creating such a climate stress test is a very daunting task. Relative to existing macroeconomic stress testing, the economic impact of climate change takes place over a much longer horizon, decades rather than a couple of years. The interactions are also much more complex, with endogenous behavioral responses, feedback effects, and nonlinearities. To sum up, financial regulators are just starting to work out approaches such as scenario analysis and stress testing to understand the many dimensions of climate risk. Researchers can support this effort in a variety of ways by helping to improve the quality of data, methods, and models. Thank you for your attention. I'll stop here except to introduce our next panel discussion on macroeconomic risks of climate change in the United States. This discussion will be moderated by Amir, Jina, an assistant professor at the University of Chicago's Harris School of Public Policy and a founding member of the Climate Impact Lab. Amir will introduce our panelists, who will overview their research before a moderated discussion. Questions from the audience can be submitted through the Q&A feature. Thank you.
Thank you very much, Glenn. And thanks to Glenn and Saul for setting up the order for the day. As was pointed out, we're going to we have a panel put together to talk about the macroeconomic risks of climate change. And we have three excellent panelists: Marshall Burke, Tatjana Derigina, and Pete Klenow. And we're going to have at the start about 4 or 5 minutes of slides from each of them, and then some discussion and time for plenty of questions. So please add questions in the Q&A function. So I think we'll start first with Professor Pete Klenow, who's going to kind of set the tone a little bit for how we should think about the relationship between climate and the macroeconomy, or the economy at a macro scale. Pete Klenow is the Ralph Landau Professor of Economics at Stanford University, the Gordon and Betty Moore Senior Fellow at the Stanford Institute for Economic Policy Research, and the Dongwei Fellow at the King Center for Economic Development. He's the co-director of the Economic Fluctuations and Growth Group at the National Bureau of Economic Research, and the co-editor of the American Economic Review Insights Journal. And so please take it away, Pete.
Okay, thanks for the introduction. Hopefully you can hear me okay. So I'm a growth researcher, so I'm going to be talking about macroeconomic top-down perspective that Saul mentioned. And I wanted to mention some background ideas and then end with a discussion of how growth researchers think about growth and how that might mean that climate change would interact with growth. So one of the first key lessons I think we've gleaned from decades of research is that technological change is a key driver and probably the key driver of long-run growth and incomes. So you might think of something like physicals capital, but if you have the same quality of equipment and structures, they run into severely diminishing returns. Similarly, you could get more workers to work per capita, but there's only so much you can do with that. So some countries have grown pretty rapidly with increases in schooling and physical capital and labor force participation, but that's more of a one-off. So South Korea or China got a lot of growth from that, but then it wasn't a sustained long-run source of growth. There's other things that are near and dear to my heart, like how efficiently do you use the capital and labor you have? For example, are people of all the same ability? Do they have the same opportunities to pursue their comparative advantage? Or is there discrimination in certain occupations or in access to education for different races or different genders? So I think there's big level improvements that countries can enjoy by improving the allocation of resources, increasing schooling investments, increasing investment in physical capital. But all of those are kind of one-off level effects, that the long-run source of growth is technological change. And then the corollary to that then is, or a corollary to emphasize of that is that technological change, because ideas are non-rival, because the same design for equipment can be used in many different countries at once, is to keep in mind that ideas can flow across countries. So take patents as a crude proxy for technology. The majority of patents are filed by foreigners in every OECD country. And the smaller the country, the bigger the fraction that come from the rest of the world. So Belgium has 1/6 the population of France, and a lot fewer researchers in Belgium than France. So not surprisingly, there's more French patents in Belgium than Belgian patents in Belgium. But that means small countries with a small total amount of labor, a small total amount of research can still be just as prosperous as a much bigger economy like France. And that's because the technology can flow across countries. So patents are one kind of trace signal of that. Another is that if you think of some technologies being embodied in equipment, equipment can be traded across countries. And in fact, a lot of equipment in most countries comes from a few other countries like US, Germany, and Japan, for example. And another mechanism by which ideas can flow across countries is foreign direct investment. So for example, there's been a major increase in productivity in the retail sector in Latin America associated with foreign retailers, foreign multinationals. Another example where you can see ideas flowing across countries in a sector that's very much affected by climate change is the agricultural sector. You can see that hybrid seeds developed in, say, Mexico can be used in some place like India. So two key things so far: technology is the long-run driver of growth, we think, and technology can flow across countries. So this is one broad empirical picture to illustrate that. What I did is took 100 countries in 1980 and put them into deciles, so 10 groups of 10, and put them in their productivity relative to the United States. So the United States is a 1 all the way throughout this. So if everybody's kind of the same position, you could see parallel lines, which you pretty much see. You see some movements. In fact, the only big deviation is somebody started at the top and came down, and that's actually like a lot of OPEC and oil-rich countries, where a natural resource wealth became less and less important over time. So the picture that this portrays, and there's a lot of detailed research underlying this, is that countries are fundamentally connected and tethered together by technology. So you don't want to think of like extrapolating high growth in Japan or South Korea for many decades. You want to think of that as a transitional phenomenon that moved them up in the distribution, and that the long run growth of all these countries is being tethered together by our joint development of technology. Okay, so another key thing then is once you say technology is driving growth and it's driving growth throughout the world, what's driving that growth in technology? And then the key ingredient is researchers, is people coming up with new ideas, entrepreneurs and researchers. And so if you think about patents, there's a very strong scale effect. The bigger the country, as I mentioned, the more patents they get. But that same thing occurs over time. As we've had population growth over time and devoted a higher fraction of our population to research, that's been a fuel to technological change and growth. But at the same time, that would, if you thought, well, more researchers mean more growth, how come the growth rate hasn't accelerated? The way we reconcile that is saying it's actually getting harder and harder to find technological change, to make progress with the same amount of research. So it's only by having ever more research effort over time that we've been able to sustain growth. So a picture consistent with that by a recent study, this is just a longer period, 1930 to the 2000s, and you see in the green curve, huge increase, factor of 20 or more, in the total amount of research effort. At the same time, growth rate has been flat. Now, this is from a macro point of view, but you could do this at the firm level, you could do it at the industry level, you could do it at a class of technology. So one of my favorite examples is Moore's Law. So every few years, you have a doubling in transistor capacity on integrated circuits on this really important technology. So the growth rate, if you plotted that, is flat, because the rate of progress is flat over time. But if you plotted the amount of effort that goes into research in semiconductors, it's exploded. So we've had to put more and more effort into maintaining this doubling every few years in semiconductor quality. So that's telling you then that the growth and amount of research effort is going to be important for sustaining overall growth in technology. Okay, so how does climate change interact with this? With this background ideas, my first thing I think about is, if climate change did affect long-run population growth, that would affect the long-run growth and research effort we could put in. If it slowed it down, that would slow down the rate of technological progress. So that would be one potential mechanism by which climate change could affect growth. But I could think of other mechanisms, like if climate is changing, more and more over time, and we have to put more and more, a higher and higher fraction of our research has to go with limiting the damage from that, or mitigation or adaptation, then that's going to mean the fraction of research, or the total growth rate of research is devoted to improving productivity is going to shrink. So it's as if we have lower growth rate in researchers devoted to improving productivity. So that could be a really important channel. But I want to emphasize that would be at the world level. That would be at the world level, we'd think about technology growing slower, and that would slow growth rates all over. The kind of thing that could show up at the country level, I think, would be like the direct effects of climate change on, for example, agricultural productivity. And that would be something like ever rising temperature that would affect the growth rate. And that's some things you saw earlier. But one of the key things, I think, from the growth perspective, the growth researchers like myself and many other people in this field, is that we do not expect to see growth effects at the world level or even at the country level from like a permanent increase in the level of temperature. That those would have level effects that would be adverse, it would be damaging, but the kind of thing that would lead to growth effects would be ever increasing temperatures. Okay, I'll stop now, and I think we're going to have some interaction between me and the other panelists, but I'll stop now.
Well, thanks very much, Pete. This is great. I think we'll move on to Marshall's slides, and we'll save the kind of, once we've seen the overall picture from the three different aspects of this problem that you bring, we'll have some general discussion. So save your thoughts, Marshall and Tatjana, you can save your thoughts on Pete's presentation for a few minutes. So next we'll have Marshall Burke. So Marshall's an associate professor at the Department of Earth System Science and deputy director of the Center for Food Security and the Environment and the center at the Friedman Berkeley Institute for International Studies at Stanford University. And he's also a research associate at the National Bureau of Economic Research and co-founder of Atlas AI, which is a remote sensing startup. Marshall's going to talk to us a little bit about his work, specifically thinking about the macroeconomic effect of temperature changes, kind of the empirical aspect to some of the things that Pete had just introduced us to.
Now you can. Thanks, Amir. Thanks to the organizers for this great event. Super excited to be here. Really stacked lineup, so I'm going to learn a lot. So as Amir said, I'm going to take a much more empirical approach. I think Pete just gave a very nice and thoughtful, more theoretical understanding of where growth effects might come from, either in the short run or in the long run. I'm just going to look at some data, and this is going to fundamentally be backward looking. Those are the data we have to play with. But I'm going to show you sort of what we can learn, what we can and can't learn at the macro level, at the country level, or at the district level from looking at aggregate output and seeing how it evolves as a function of observed changes in the climate. Let me start extremely pedantically. So temperature obviously has to play some role in the amount of things we produce. So here are the coldest places on Earth. On the left, Antarctica, about -30°C. On the right, the Sahara Desert, plus 30°C, right? And, other than scientific research stations and the, occasional salt train going across the Sahara, we are not very good at using these temperatures to produce things, right? It turns out between those two temperatures, though, there are temperatures where we find ourselves very comfortable and very good at producing things. Some of the most productive places in the world are around 10 to 15 degrees Celsius. Here's Manhattan. Average temperature of New York is about 13 degrees Celsius. It turns out that's the exact average temperature of Bay Area where I am right now. Many of the wealthiest places around the world cluster at temperatures, again, near this. So there are temperatures at which we are bad at producing things, and there are temperatures which it turns out we are much better at producing things. We can do this with data. As Saul pointed out at the beginning, we don't just have to look at pictures I took off of Google Images. We can actually make pretty quickly make plots like this that show on average the cross-sectional relationship between, again, average temperature. And this is a very blunt measure of climate here. This is just a country average temperature, averaging over day and night, winter and summer. And we can relate that to average output. So here's GDP per capita. And again, you get sort of this hill-shaped relationship, if you will. We don't have a lot of exposures out at the very cold end. But you see overall throughout much of the distribution, again, on average, a downward sloping relationship between hotter average temperatures and country GDP. Again, just a cross section. We can drill down. We can do this at the country level. So here are US cities. This is MSA data from the US. Here, the scatter is a little bit wider. So you have to blur your eyes a little bit more. I did that blurring with the low S fit. And here, again, you see a sort of a hill-shaped relationship where output appears to peak, again, on average, somewhere between 10 and 15 degrees Celsius. and drop off on either side. Again, consistent with our Antarctica Sahara interpretation. Okay, but everyone is probably saying in their minds, okay, that's just correlation, right? These are just averages, and average temperature could be correlated with lots of other things that also affect output. So we typically don't use cross-sectional data to try to study this question. We rely much more on panel data. So this is repeated observations of units over time. And now there are well-honed methods using this panel data to isolate the impact of some independent variable, and here it's going to be temperature, on some outcome that you care about. And here we're going to look specifically for growth effects. So we're going to ask historically, have warmer or cooler average temperatures? So if the temperature warms up or cools down historically, has that affected the growth rate of economies around the world or units within economies? One wonky point that I'll just go over quickly to do that, the cookbook was this earlier very nice paper by Dell, Jones, and Olkin, now almost a decade old, that sort of told you how you had to do this if you really wanted to look for growth effects. And that's, you have to include multiple years of temperature in your regression, and you have to add up the effects of those temperatures. Happy to talk more about the details there if needed. Okay, so here, let me show you a few examples. This is from a paper with Saul and Ted Miguel that we had a few years ago. This is if you just use a global panel and you run that Dell, Jones, and Olkin cookbook where you, again, we're studying the effect of fluctuations in the growth rate as a function of fluctuations in current and past temperatures. And what we find when we do that is, again, this hill-shaped function that actually looks, at least in shape, a lot like the cross-sectional results I showed you before. At between 10 and 15 degrees Celsius, the first derivative is pretty flat. So small changes in temperature don't appear to affect the growth rate. But if you're in a really cold place, warming up increases your growth rate on average. And if you're in a really hot place, the reverse happens. Okay, so this is a global look. This is using a half century of growth data from around the world for national accounts data. We can also do it subnationally. So this is a working paper I have with a really excellent grad student at University of Chicago, Vincent Tamma. And here, for most economies in the world, we're able to put together district level GDP data. And again, in this panel setting, we can run a very similar analysis. And here's a bunch of different models and data sets you can throw at that. But again, we get a very similar shape where above about 15 degrees Celsius, you get this very strong downward sloping relationship between temperature and the growth rate. Okay, so here we're in the US. What's going on in the US? Sorry, this figure's a little blurry. We can estimate this just for the US, and we can ask, okay, is the US response, again, in these data somehow fundamentally different than the global response? And in fact, no. So the blue line is if you just do the analysis in the US. The black line is the subnational analysis from around the world. And these line up almost perfectly. And that's not mechanical. We can drop the US from the international analysis and you get the same thing back. So the US doesn't seem somehow fundamentally different in this analysis than other countries. So I'll stop there. So again, to wrap up, we see a global nonlinear response of growth rates to temperature. And these do look like growth rates, at least empirically. Pete's thinking is really important on this to try to understand them. I think these sort of blunt data don't give us a real sense of what's going on under the hood. Hopefully Tatiana will talk about that in a second. But again, just in terms of stylized facts, this is a stylized fact. We do see these responses of growth to changes in temperature. I'll stop there. Thanks.
Thanks very much, Marshall. So then finally, last but not least, we turn to Tatiana Jina. She's an associate professor at the Department of Finance at the University of Illinois at Urbana-Champaign and a research associate at the National Bureau for Economic Research. Now, her research is specifically interested in long and short run impacts of disasters and other aspects of the climate and how they are mediated by social policy and disaster aid. So I'm hoping Tatiana is going to get, as Marshall said, get a little bit under the hood here and start pushing us towards thinking about some mechanisms behind some of the results we've seen so far.
Okay, thank you very much. I'm not sure, can you see the right slides or are you seeing the slides with the notes? Anyway, hopefully you're seeing the main presentation. I have two screens here. Okay, I don't really know how to do this. Sorry about that. Let me see if I can. Okay. Anyway, I'm just going to go ahead and do it this way. Hopefully you can all see this. I'm going to touch on two macroeconomic risks of climate change, and that is temperatures, talk a little bit more about disaggregating the aggregate relationships that Marshall showed, and then also talk about natural disasters by talking about two examples of studies of the effects of hurricanes. Using panel methodology similar to what Marshall talked about, Hsiang, who you heard from earlier, and I have estimated the effect on temperature increases on income in the United States. As all other empirical studies, this is indeed backward looking in that we're using the historical relationship between income and temperature to inform our understanding of what could happen in the future. And what we do in this work is we try to account for future adaptation by looking at a nonlinear relationship between temperature and income. And it turns out that when you account for adaptation, and you also account for whether counties are urban versus rural, because as we demonstrate, it really matters what kind of county we're talking about, you get a picture where some counties in the United States are going to be big losers from climate change, and some will potentially big winners. And that's illustrated on the left map that you see on your screen. We do this for 43 possible climate change scenarios, and here we show the median change in income in billions of 2011 US dollars in net present value. So some counties in the Midwest and the Northeast, as well as in the West, are going to lose as much as $4 billion in net present value, while some counties in the South are going to gain almost as much. And that's because these counties in the South, we estimate, are particularly well adapted to climate change. Now, I should say that an important caveat here is something that Sol touched on in his introduction, that some of the temperatures we're going to be seeing by 2100 are outside of the normal range of what we see. So there's necessarily some uncertainty associated with these estimates. However, this is the best answer that we have so far. And on the right-hand side, we show what's happening to total farm income, because when people tend to think climate risk, the first thought is agriculture. And indeed, agriculture is quite vulnerable to climate risk, but the agricultural losses, which are almost everywhere losses, do not explain the full loss of income that we expect to see as a result of climate change. So some sources of uncertainty here are, first, as I mentioned, the distribution of temperatures is going to shift so far to the right that we're relying on relatively few observations to extrapolate these projections. And second, this is for the median climate scenario. There is quite a bit of range from the best to the worst. And in particular, we see a lot of variation at the lower level. So we see almost essentially no scenarios where there's aggregate gains, but we see scenarios where the losses are much, much larger than the median. And the last point I'll touch on is natural disasters, which is the tail risk that was mentioned in the introductory opening. So there's two papers here, Hsiang and Jina, 2014, that look at the growth rates of cyclones. And the graphic on the left is from The Economist, basically illustrating that the most severe cyclones have a similar effect on growth as a banking crisis. So even though in the United States, we don't expect the entire United States to be affected by cyclones, we have seen big cyclones like Harvey, Katrina, and others severely disrupt the local economy. And what these researchers shows is that this can be detected in aggregate growth rates as well. And the last point I want to make that's particularly relevant to the US is that even though we're talking about physical risks of climate change right now, we can't really separately identify physical risks from existing policy. So what I showed in a recent paper is that when a cyclone or hurricane hits a United States county, that county experiences persistent increases in transfers from the federal government. And this is not just FEMA aid. So what I show is that other programs like unemployment insurance, food stamps, and other income transfer programs are significantly affected by a hurricane strike. And so what this means is that we can't just rely on measures of growth rates to understand the full economic impact. In fact, what I see is that there's relatively small and transient effect on a county level employment. The average hurricane has no effect on income at all, but we do see this large persistent increase in transfers. And so what this implies is that the increase in transfers is likely helping offset some of the income losses. And so we need to look at the full picture of impacts, not just necessarily focusing on impacts on income, but thinking about how that interacts with existing policies. And I think I'll stop there so that we have plenty of time for discussion. Thank you for your attention.
Great, thank you very much, everybody. So I wanted to just give you all a few minutes to maybe react or discuss some issues that arose in all three. In particular, maybe starting off with thinking about how to square some of these empirical results. Maybe this is a question for Pete. How to square some of these empirical results with the type of mechanisms you were thinking that are theoretically founded here.
Yeah, let me say, in looking at some of Marshall's plots, the growth effects are really large and really persistent. And that's surprising from the point of view that growth rate differences across countries aren't very persistent. There's exceptions like China growing persistently fast and Venezuela persistently plummeting. But for the most part, countries' growth rates are very connected. So how can I square this? How can he estimate such large persistent growth differences? I think it comes from looking at something Tatiana mentioned, which is the variation in the data and the temperature. The good thing is it's random. It helps with identification. The bad thing is we're interested in long-run effects of permanent large changes. And he's estimating, he and his collaborators are estimating off of small transitory changes. So that's really dangerous to extrapolate. And if you overfit, you'll end up saying, look, there's these really large differences that are going to persist over time, which in the long run, it may be because of nonlinearities that Tatiana mentioned, the effects could be much worse than you estimate from just small transitory changes. But it does mean you don't really have the experiment you need to see it. And I'm saying, if I look at all the evidence overall, I'm just not seeing persistent growth differences across countries. So that makes it hard to imagine persistent effects of past temperature differences, because we don't see persistent growth differences in the past, despite very persistent differences in temperature.
Amir, can I respond to that? Yeah, thanks, Pete. I think that makes a lot of sense. So I think 2 points. One is that we don't need to have large long-run effects. These growth rate differences do not have to be that large at an annual level, right? We shave 0.1% off growth for 50 years or 100 years. I mean, you know this obviously, or 0.25%, right? Which is basically what our estimate would say for the US, right? We get GDP differences 50, 100 years from now, they're like 20, 30%, right? So small effects can matter here over the long term, number one. Number two, I agree with your point about the importance of distinguishing the potentially different effects of small transitory shocks from longer term changes. There are some methodologies that we can throw at these data that try to exploit longer term variation. And so we can run basically along differences. We can compare countries or places within countries whose temperature changed much more quickly over the last 20, 30, 50 years, as compared to other nearby locations whose temperature, for reasons related to natural climate change, at least historically, didn't go up as much, right? And so it's sort of it's using a very different type of variation. And when we run that, we get results that are almost identical in terms of their growth effects to what I showed in the shorter term panel. So again, just in terms of a stylized fact, I'm not saying we fully understand those results, right? But exploiting a natural experiment that I think is much closer to what you just proposed, Pete, we get results that look really similar.
I think just to interject in this discussion a bit, or to broaden it out a bit, it seems like one thing we could conclude from this discussion that you're having is that there's potentially some uncertainty here in what these macroeconomic effects might be. So if we think about the consequence of that uncertainty, if we're thinking of models of the global economy that assume there's going to be reliable growth regardless of climate change, and we think about these as either small effects, we think there could be some small effects on growth, but maybe with uncertainty about them. Would current assumptions about a stable path of growth without climate change be an underestimate of these risks if we're not taking into account even the uncertainty, the fact that there could be within this uncertainty range some kind of impact? And how do you think we could improve upon that price tag that we'd be putting using some macro projection models?
So, I mean, I think the first part you said about what would growth be in the absence of climate change, actually population growth is slowing down and the projections of fertility rates are declining. So that would be a reason to be pessimistic. People are making those choices. Maybe those are good ones and actually good for mitigating some climate change, which has some positive elements. But it would mean that we have less growth in research and less reason to be optimistic about future technological change. There's forces going in the other direction too. But I mean, the other thing I guess I would say when thinking about, how things can be studied better, take into account the fact that countries' growth rates are linked, that you don't want to think of them as separate planets where you're just saying this is an observation that's independent from everything else. And once you see that, then you'd model that growth, instead of being standalone, temperature in one country affects growth in a country, temperature in one country would affect the relative income in that country. So I think the understanding that technological change is going to be a critical element in the global growth process for any persistent growth effects is important for getting a better handle on what might happen.
Can I also jump in with something that's related to that? Related to productivity and technological innovation, there's a lot of evidence that heat has negative cognitive effects. And so I think what we need to potentially better understand, given the emphasis on technology as a driver of growth, is to what extent our temperature is going to affect our ability to do research and development. So there's a fairly large literature on heat and test scores showing that individuals do worse on test scores on the day that it's hot, and also if they had been in a schooling environment that was hot without air conditioners. And these kinds of effects could affect our ability to actually innovate in the future. And I think those could be considered as well.
I agree with Tatiana on this. Pete and I actually emailed about this last night. So I would love Pete's view as well. But yeah, but both in test scores and then now people have been being put in randomized control trials in office environments where they crank up the temperature. And so it's not just students in classrooms, it's people in quote unquote white collar jobs having to perform their normal duties and doing much worse, either when you make the temperature really cold or when you make the temperature really hot. And so actually the responses at sort of the very, very micro level in these lab experiments look surprisingly like the macro responses we see. Now, again, maybe that's coincidence, but as Tatiana said, that seems, even in Pete's framing, that seems to me like a plausible channel through which you could generate, changes in the amount of ideas that we generate over the long run.
Keep in mind, though, those would be level effects. If we had a permanent increase in temperature and without air conditioning, as Tatiana imagined, so that researchers or people trying to innovate, entrepreneurs everywhere, suffered cognitive impairment because of that, that would be something that would lower the level of innovations they could produce. But without changing the growth rate, without future increases in temperature, ever increasing temperature, you wouldn't expect that to have a growth impact. It fundamentally would be a level effect. And Tatiana's estimates were level effects, for example.
But we're looking at ever increasing temperatures, at least on a meaningful scale, right?
Right, but the estimates that you presented, which were very large, were temperature levels affecting growth rates. I think that's fundamentally misspecified, and that's both conceptually and empirically. Like, I think Tatiana, tell me if I'm misinterpreting your evidence, Tatiana. I thought your evidence was level effects on agricultural productivity, for example, of temperature regionally.
Yes. Although we do find evidence of growth effects as well. And I know that this might be too technical for this panel, but we also do show in the paper how one can relate the effects of temperatures fluctuations to the effects of climate. And under some conditions, you can actually identify the long run effects of a marginal change in climate using short run variation in temperature changes.
I want to change tack for a bit and pick up on something that Glenn mentioned about climate stress testing as an economy at the macro scale, which relates to a thread which is going through this a little bit. Thinking about how these climate risks might propagate through, from one part of the financial system, which is climate exposed, to others. And Tatjana, your work particularly thinks about that. I wonder if you could comment on this kind of linkage between sectors in the economy we might see, which comes, I think, a little bit back to what Pete had said originally. If there's something which might pull away from investments, if we start investing too much in climate change, can that pull away productive investments from other places? I just wonder if you could touch on, in particular, could you comment on how we might think about those linkages, or what the evidence is that exists on those?
So honestly, I think we have relatively little evidence. There's recent papers on thinking about how trade is affected by climate and how it will exacerbate or ameliorate the effects of climate change that looks at linkages across countries. We find some evidence of spillovers of temperatures to neighboring areas as well, but our understanding of the mechanisms is very incomplete. And I think it's very possible that there are important linkages that we're missing, some of which probably ameliorate the effect and some of which exacerbate it. So I wish I had a better answer, but I actually think the right answer is that we know very little about this.
I was going to say my presumption is we're investing too little in green technology. So when I was picturing that we would invest more and more over time as a fraction of our research effort would go into mitigation, I was picturing that might be optimal. And in fact, we should have a promise right now of not only a carbon tax, but a rising carbon tax that would induce more research today to try to internalize that.
One thing, again, kind of just sticking with this idea of the linkages and something that Pete said of looking at growth rates of countries in isolation. What do you think, what do any of you think we can learn? There's a lot of research here within the United States. What do you think we can learn about from this research about this more interconnected aspect of the global economy?
Well, I would say, fortunately, ideas flow. I mean, this is not so much climate, but ideas flow across states. So, ideas developed in Silicon Valley can be used in the rest of the country. Ideas developed in Michigan people can buy cars the world over. So the same idea of technology can flow across locations within a country. Means that across countries means that it can flow within a country maybe even easier. So that's my first general reaction, but not climate specific reaction.
I think Tatiana's results within the US on the transfers is really important here for when we run these sort of empirical analyses, either within countries or across countries. I think there's a lot that countries can do within their borders to ameliorate these impacts and transfer from unaffected to affected areas. And I think Tatiana's work shows that very clearly. And I think the result of that is then when you run an empirical analysis relating some aggregate measure, either income or GDP, to temperature, you get a flatter response within countries than you do across countries. And I think the transfer story is maybe one or trade or some sort of internal movement of things within countries is the main explanation for that. So I think we shouldn't be surprised when we see sort of differential effects when we look at those two scales. We haven't done a good job. Every climate agreement has some fund for exactly those international transfers. Historically, those have been relatively small and people haven't always held up their end of the bargain in terms of the announced transfers that are going to flow from wealthier nations who have caused the problems to poor nations. So that would be the analog. We just haven't seen it at the scale as we've seen it within countries.
Okay, I think we have about 10 minutes left. I'll turn and I'll start trying to look for some questions from the audience. So thanks for everyone who's added questions so far. So first we start off with a question from Michael White for Pete. How would the expectation of declining temperatures in the future affect growth rates during a time of currently increasing temperatures? So if there's some overshoot scenarios. I guess you could also just generally talk about or elaborate on this idea of the permanent increases in temperatures you mentioned.
Yeah, I guess my prior is with Marshall that we're facing ever increasing temperatures over time. So I think this says, suppose that's wrong, and suppose temperatures are actually going to come down. I think if I understand that question correctly. I mean, one reaction I have to that is, it would certainly go against my recommendation that we have high and rising carbon taxes to induce technological change that's more climate, change mitigating, because it would mean we'd overinvest in that. If that forecast is wrong, which I have no reason to believe that the forecast of ever rising temperatures is wrong, but if it is wrong, then that means my policy recommendation would be very wrong from the mark, off the mark, and that means we'd be investing too much in mitigation because we would be facing much lower temperatures than I'm building into that carbon tax plan, a carbon tax path. That's my reaction.
No one else has any thoughts on that? There's another one here, something we haven't talked about so much, which is about adaptation. So a question comes in, isn't the key issue not just temperature levels, but the rate of change of temperature? And I guess that speaks more broadly about what do we know about adaptation in any of the empirical work that we've seen here? And potentially this connects to how fast or how slow we might be able to respond to changes.
So I'd like to say a little bit about adaptation. I think conceptually it clearly matters whether temperatures increase quickly or slowly. Obviously if we jump to the 2100 projections today, it would be quite a huge shock, especially in places that don't currently have air conditioning. But I think even more importantly for thinking about adaptation is remembering that it is not costless. So I see a lot of discussions of climate change where people just say, oh, well, but can't we adapt? And maybe we can fully adapt, but at what cost? That should be the right question, is not can we adapt, but what is the cost of adaptation? Because even if complete adaptation is possible, it might be very, very costly, and we might still prefer to mitigate.
Yeah, I 100% agree with Tatiana. I think there's good evidence. I think our best evidence on adaptation is in the health impacts. So both we've seen overall across the US a declining impact of hot temperatures on mortality. And then a given hot day has much less of an effect in a hot place than in a cool place. And I think both of these are consistent with some notion of adaptation. But as Tatiana said, and Amir, and you guys have nice work on this, this comes at a cost, right? We have made a lot of investments to make both of those facts true. And that's money that could have been spent on something else per sort of Pete's earlier setup. So I think both of those things are true. We can adapt, it is costly.
Another question comes in, I'm paraphrasing from Chris Grant. So something that we potentially all dread thinking and talking about, given that the global climate is a complex system and there might potentially be tipping points, is there any way to account for this in the research or in our knowledge, or does that just enter as a fundamental source of uncertainty? Again, I guess it comes back to the question of, when there are large uncertainties here, what might be the best path forward for thinking about the future growth of the economy in that case?
Well, one reaction I have is that it calls for precautionary investments. If there's a small probability of really horrible outcomes, we should be investing, a lot more to try to prevent that horrible outcome, even if it's not the most likely scenario or even likely. Because that scenario is so bad, avoiding that disaster is really important to make precautionary investments to avoid that. That's my general macro response to that.
I think an empirical question, agree 100% with what Pete just said. like Saul started his earlier remarks, if folks saw that, with these plots from sort of deep history on the effects of, past environmental climatic calamities on the collapse of societies. And I think it's definitely very interesting to think about what implication those have for our current society. Like, should we not take them seriously because they're so long ago, or do they actually have lessons for what happens? I don't know necessarily how we answer that historically, but or empirically, but we definitely have these historical examples where things have gone badly, and often gone badly quickly and in a protracted way for decades, and we've seen societies really fall apart. We see that more currently with the relationship between changes in climate and various types of conflict around the world. Sort of a lesser version of the same point. But I think we ignore that evidence completely at our own peril. I think we should at least think about the implications for us.
I think one important implication of tipping points is mass relocation and mass conflicts. I think it's really hard to quantify the economic costs of tipping points because we don't have data on them, but just thinking about their nature, like changes in ocean currents or runaway greenhouse effect, one thing that could potentially trigger is massive conflicts and massive relocations. So we can't quantify the cost of that either, but it should make us more likely to invest in mitigating the effects of climate change.
And I know there's a lot of questions coming in, so I've been trying to group them together to some extent. They're, particularly some about adaptation in general. One here, which we haven't touched on so much, from Gideon is, can we discuss the positive impact from climate change on cold regions and how that balances against the negative impacts expected in moderate or high temperature regions? So I guess this is multiple ways to answer this question, but just as a general fact that looking in a high resolution sense, we see that there are very differential effects across the world. Any of you willing to comment on that or the implications of that?
My sense is we have both macro and micro evidence that cold places benefit when it warms up a little bit. Again, this is intuitive. You can see this very clearly in Icelandic GDP data. As it gets warmer in Iceland, warm fluctuations are associated very strongly with more positive GDP anomalies. A lot of underlying micro evidence for this: agriculture, labor productivity, things like that. But going forward, when we think about these large changes, then we have to think about the integrated nature of the global economy, countries trade, ideas flow, and again, here's a setting in which I think we want to be careful about those effects. But at least looking backwards, yes, I think there's strong evidence that cold places benefit from at least some increase in temperature.
So again, trying to take some points there. Tatiana, there's a specific question for you, which I can't see now on the list, but to expand a little bit more on the transfers point. So to expand a little bit on your research on transfers, if you can.
So I'm also trying to see what this question.
Yeah, there's thankfully a lot of questions from people.
Yes, so just thinking. So first, I think the resultant transfer. So basically, there's all these programs we have that are not disaster specific per se, but are nonetheless affected by disaster. So it's pretty simple. People become unemployed. They are eligible for unemployment insurance. So this should make us both more pessimistic and more optimistic with respect to dealing with the natural disasters threat. It should make us more pessimistic in the sense that some of the existing non-effects we see in developed countries might be the results of these extensive transfer programs, because we're not good at systematically measuring their costs. So typically we just add up the cost of the disaster aid, and that's what we call, the fiscal cost of the event. But my research suggests that the fiscal costs are really much higher, which have negative connotations for what the real effects are of the disaster without these transfers, and what disasters means for the fiscal well-being of a country. Now, the optimistic way to look at this is to say we could actually be dealing much better with natural disasters in developing countries, because developing countries lack a lot of these social safety nets. So in some sense, you can kill two birds with one stone and improve the functioning of the social safety net in developing countries. And with that, you will also be addressing a non-trivial risk of climate change, which is these natural disasters. Of course, not fully addressing, but to some extent.
I think that's about our time. And thanks for everybody. And I like that question at the end, because, or that answer at the end, which is linking us a little bit more to the micro level and some of the discussions that will happen in the next panel. So in the next panel, we're going to have Tamma Carleton, who's an assistant professor at the University of California, Santa Barbara, introduce the next speakers. And thank you, everybody, for your questions and for your thoughts on this issue.
Thanks so much, Amir. Hi, everybody. So as Amir mentioned, what we've done so far is sort of talk about the scope and the magnitude of the economy-wide risk of climate change. And what we want to do in this panel is sort of drill in on particular sources of risk and focus on where within our country populations are the most exposed to those risks. So we're going to be talking about a range of different climate-driven risks here, and we're going to go through 4 different panelists, each for a short presentation, and then have a discussion at the end. So feel free to send in questions that pertain to a particular topic, or questions that sort of cut across these different risks. And we want to focus on a discussion that can speak to many different risks. So first, we're going to start talking about flooding. And our first panelist is Miyuki Hino, who's an assistant professor in the Department of City and Regional Planning and an adjunct assistant professor in Environment, Ecology, and Energy program at University of North Carolina at Chapel Hill. And Miyuki's research looks at the linkages between natural hazards, governance, and public policy, and in particular focuses on how we can achieve effective and equitable adaptation to climate change. And she's going to talk about coastal risk with us today. Take it away, Miyuki.
Thanks, Tamma. Let's see. All right, hopefully all of you are seeing my screen now. Thanks, Tamma, and I'm happy to be here. This is gonna be a fun day. And today I'll be talking about coastal risk. And I think when most people think about climate change and coasts, they think about hurricanes. And that's probably especially true given that we just came through a record-setting hurricane season that ended officially on Monday. And we see headlines like this, unfortunately, frequently, right? They really reinforce just how costly these big storms are, both in terms of human health and well-being and in financial terms. But these numbers here that you tend to see in the headlines, they really only scratch the surface of the risks that coastal communities face from climate change. So to kick us off today, I really just want to make 3 main points about the nature of coastal risk with climate change. So the first point, and we've talked about this a little bit already today, is that the damages associated with coastal storms really extend far beyond what those numbers would suggest. Those numbers tend to be based on physical, immediate damage to housing and infrastructure. Those are big ticket items, but they miss a lot of important things, right? They miss long-term damage to mental and physical health from these traumatic events, both short and long-term changes in income and economic growth. And we also have reason to be concerned that in the recovery process, the wealth gap widens. So if before the event you had more, you end up with even more relative to people who came in with less. The second point I want to make is that even beyond these big coastal storms, coastal communities face a whole host of other concerns with climate change. So we have sea level rise that causes more rapid erosion, salt water to go farther and farther inland, and of course, more frequent flooding. So this figure here shows a number of different tide gauges across the United States. And the height of each bar is showing the number of days each year that tide gauge is recording flooding. So what you can see is in the 50s and 60s, most tide gauges were seeing 0, maybe 5 days per year of flooding. And that has really accelerated in the last couple of decades, where now many locations are recording 30, 40 days per year every year. These are usually relatively small events. They're not storm induced, right? They're caused by a higher than normal high tide or a strong wind blowing from a certain direction, but the costs really add up. And we've done work in Annapolis, Maryland, which I think is this red bar here, where the historic tourist district floods pretty frequently. And we found that already businesses are seeing about 2% fewer customers due to these tidal floods. And that number jumps up to about 24% fewer customers with a foot of sea level rise. That's of course not to mention all the other negative effects of these types of events. School buses can't get to certain neighborhoods and pick up kids, for instance. Commutes become much longer, much harder and unpredictable. Emergency services get cut off, that type of thing. The third point I want to make is that the same changes in the physical environment can lead to very different human impacts. So this is a screen grab from Zillow just a few days ago, and I've highlighted in red here 2 houses that both appear to be about half in the ocean and also worth hundreds of thousands of dollars. This is what that house looks like on the ground. And the reason I'm showing this is, we all see maps of inundation from sea level rise, whether it's 1 foot, 3 feet, or 6 feet. But it's not always the case that water defines the boundary of human settlement. It's actually often the case that human settlement defines the boundary of water. So we might have this mental model that as sea levels rise, gradually land goes underwater, people move away, property values drop. But in reality, people respond to these changes with the resources that they have available to them. And that process of responding can lead to really deeply inequitable outcomes. So to wrap up, I really just want to emphasize that I think this fact that coastal risk is not going to be experienced equally needs to be sort of at the forefront of our decision making, not only for federal response, but all the way down to local scales and up to international scales as well. Thanks, I'll stop there.
Thanks so much, Miyuki. And I definitely want to touch on those distributional effects when we look at some questions across all these different types of risk. So we're going to stick with the topic of flooding here and now hear from Eric Tate, who is an associate professor in the Department of Geographical and Sustainability Sciences at University of Iowa. And Eric studies the connections between natural hazards and society, but really through the lens of modeling social vulnerability and risk. So take it away, Eric.
Thank you. Great start to this panel. I'm going to continue with this theme of inequitable distributive risks by taking a big focus on who lives in the floodplain. So what I would say is we have a pretty good understanding these days, more than ever, of what's in the floodplain, where floodplains are. There's a map of flood maps that FEMA has created, supported across the nation, and we see that most of the nation, especially where populated areas are covered by flood maps. There's new technology that is creating continental scale flood maps at high resolution. So it deals with some of the challenges with FEMA flood maps that are done at different times with different data using different models. And so these continental maps are comparable across places. And we're using this work in Iowa to look at differences in exposure, how exposure to floods changes across place. So this is a map just showing the places with the highest amount of exposure to floods. And so it's dominated by coastal areas along the Gulf Coast and the lower Mississippi River Basin in Central California. So we have a decent understanding of what's exposed. What about who? Much less work has been done on this dimension. And so this is some quotes from a recent National Academy of Sciences study on urban flooding in the US. And some conclusions about impacts focusing on, hitting children harder, the elderly, poor, renters, and who lives in the floodplain, poor, non-English speakers, and this has implications for before and after floods. So research has taken this understanding of demographic characteristics of who's most impacted and created social vulnerability indices. So these indicators can be mapped across space. This is showing there's sort of three big measures that are used. This is the Social Vulnerability Index created by the University of South Carolina, showing the distribution of social characteristics associated with greater vulnerability to disasters. The Centers for Disease Control has created their own model, also called the Social Vulnerability Index, and they use some different approaches, different modeling, different variables to do the same thing. The Department of Housing and Urban Development, through their CDBG program, funds a lot of post-disaster recovery. And so their main metric is low to moderate income populations. Each of these three dominant models are trying to get an understanding of who's most impacted by disasters. And all three are fairly descriptive. You can map these across space and understand places that might be more vulnerable. But there's very little understanding to what extent they're explanatory. So the places that they predict is most vulnerable, do they actually occur in observed disasters? They are generalized in that they're intended for all disasters. They're not flood focused. They certainly don't have a focus of mitigation actions before floods or recovery actions after. So we need customized measures. And so we're starting, some of the work that I've been doing is trying to understand not only who's most vulnerable, but where. So we're taking measures of what is exposed and where, people, who is exposed, combining them using spatial methods to find clusters of where both dimensions are highest. So in this map, you see really high, these high hotspots, high flood exposure and high surrounding social vulnerability that dominate across the Black Belt area of the US Southeast, Florida, the Rio Grande River Valley, for the most part. You can combine these, the characteristics of these places. So it's not just where, but who. And so we combine the high with the high flood vulnerabilities surrounded by low social vulnerability. These are both really high flood areas. And we can understand characteristics of people, okay? And so what we found is that it's housing characteristics and race that have the biggest discrepancy between, moving anywhere in the country to in one of these clustered places. And this is a little bit, distinct from common understandings of vulnerability to floods that rely on economic measures. So who lives in the floodplain? Well, we need to understand that vulnerability is multidimensional and it's inherently spatial. The configurations of where the hazardous areas are and configurations of lack of opportunities and barriers to resource access are inherently spatial. So we need to have spatial methods to understand these. We can think a lot about climate futures and, acceleration of the hydrologic cycle, but we don't even understand how things are right now. And, if we keep doing investments based on current approaches, it's likely to perpetuate the inequities that we have right now. So economic metrics like benefit cost ratios, who's eligible for certain programs, homeowners versus renters, and which disaster outcomes do we look at? Absolute damage to structures or maybe relative impact based on resources of the household. And so that's a look at sort of these social dimensions. Thank you.
Great, thank you, Eric. We're gonna move away from flooding for a moment, but please, if you have flooding questions for the two of them, put them into the chat. Now we want to talk to Wolfram Schlenker, who's a professor of international and public affairs at Columbia University. He also co-directs the Center on Environmental Economics and Policy at the Energy and Environment Concentration in the School of International and Public Affairs at Columbia. He's a research associate at the National Bureau of Economic Research and serves on the board of reviewing editors at Science. Talk today about the impact of climate change on agricultural yields in the US and what the implications of those impacts are for rural communities across the country.
Thank you, Tamma, for the introduction. And thank you for having me. I would like to sort of make 3 points about agriculture, which is still a very important component of employment in many rural parts of the country. So the first is that looking at history, we sort of have this amazing hockey stick in agriculture. So what you see here is sort of corn yields in the United States. They started reporting them since 1866. So there's this two periods that we sort of have very different behavior. Before 1940, you see here the fluctuation in yields year to year. They're fluctuating around a very stable mean. And then we start with mechanization, green revolution and everything. And we suddenly get this very impressive increase in technology that has led to this amazing steady upward trend in yields, meaning the amount of corn bushels we get per acre. So if you fit a sort of a trend line to this, you see this very, very impressive trend line. At the same time, you see though that in later years, for example, recently 2012, we still have a very strong influence of weather on agricultural yields. So there was a 25% drop in 2012, which was an unusually hot year in the Corn Belt. I can also show you on the right side here, the whole thing in logs. So if you do things in logs, then basically the deviation become in percent terms. And so you see that you have roughly sort of constant percent deviations around this trend. So we have made, in summary, great progress in agriculture, more than tripling average yields, but we have made no progress in how much we sort of depend on weather fluctuation in terms of year-to-year fluctuation in output. I should also mention that sometimes underappreciated that the United States is the breadbasket of the world. These four basic staple commodities, corn, wheat, rice, and soybeans. And together they account for about 75% of the calories that we humans consume, either directly or indirectly, because they use this feedstock for meat. And the US market share is roughly around 25%. That's important because the market share is so big that if something happens in the US, like in 2012, it has strong impacts for world prices of agriculture. So what do we sort of know about agricultural output and temperature and going forward with climate change? You see here in blue sort of a histogram of the distribution of temperatures. Sorry, this is in Celsius. So 10 degrees Celsius is 50 degrees Fahrenheit. 30 degrees Celsius is 86 degrees Fahrenheit. So if you plot on the left axis here, the effect of various temperatures on yields, you see that you have very little impact on growth below 50 degrees Fahrenheit. Then between 50 and roughly 84 degrees Fahrenheit, you see that the yield is improving. So it's basically optimal to have about 29 degrees Celsius or 84 degrees Fahrenheit for your corn growth. But then what happens is that you have this very steep decline if you get into too hot of a territory. And going forward with climate change, the important implication is that we're shifting much more of the moderate temperatures into this extreme territory that can give you a very sizable reduction in yields. And the single best predictor of year-to-year corn yields is actually just measuring how much and for how long temperatures exceed this 84 degrees Fahrenheit. So that's sort of what drives the analysis. So what does the climate models then tell us about what we are about to expect? So this is an area of all the corn between like 2010 and 18. We have nowadays satellite imagery. So we have the cropland data layer, which gives you on a 30 by 30 meter grid where corn is grown. You clearly see the corn belt in here. You can see the cities like Chicago that are sort of where no corn is grown, but it's those rural communities. So what the following slides will tell you and show you is basically the weather averaged over those corn growing areas by basically taking a weighted average. So it's one outcome per year. And so what we've seen is, this is again on the left in red here, you have average temperature. You can detect some really hot years like 1936, 1988 and 2012. And you sort of see that we had this little upward tick since the 80s. But then if you look at the extreme heat, which again is sort of the most significant driver of corn year-to-year variation in agricultural output, you see that average temperatures don't perfectly align with this really extreme measure. So you clearly see the Dust Bowl here in the 1930s. This is 1934, this is 1936. The highest amount we ever had of extreme degree days, which is on an average for the whole US over the corn growing area around 150, while on average we're much lower, we're about 30. You again see 2012, which there's a clear spike, and that basically explains why 2012 had this really strong drop in yields. We don't see it so much in the average temperature, but again, what really matters is how much time you spend at this extreme temperatures. So what is going to happen going forward? Well, under RCP 4.5, which is sort of the medium warming scenario, you see an increase in average temperature, as well as under RCP 8.5, which is sort of the more fast warming increase. So you can see here in terms of Fahrenheit, you can get a sizable increase in temperature increases. However, what's even worse is that we get a much larger increase in the extremes. So if you plot the same relationship for what is predicted to happen for the extreme temperatures, you see that they're supposed to rise a lot. And even under the moderate scenario, we're basically getting on average what we observed in sort of the Dust Bowl, which is the worst what we've ever observed in the past. So what are the implications of this going forward? Well, given this nonlinearity and us predictably shifting more and more into this extreme territory, there's sort of three takeaways. There's what we've already observed over the last 4 decades. And so in some parts of the world, there has already been significant warming. And so our panel moderator has a nice paper showing that you can attribute a sizable amount of excess death due to suicides of farmers in India due to the observed climate warming in India. In the United States, there's a bit of a puzzle. The Midwest, actually, as you might have seen in the previous graph, has not seen a really significant increase in extreme heat over the corn growing area as is predicted by the models. So the models are right on if you look at something like Chicago and the predicted increase in like cooling degrees above sort of a lower threshold like 20 degrees Celsius, but we haven't seen that warming. So what's then supposed to happen during the medium term? In the medium term, we will basically see some declines in yields as we shift more of those temperatures into the higher territory. The US is much more protected than India. We have crop insurance and so forth. And initially, it might even help farmers because for many decades, the US government has tried to limit supply to drive up the price and help farmers. So initial yield declines in a way might be good for farmers because they get more than compensated for the yield loss by having higher prices. But obviously it has implication for global food prices and it would really hurt the poor who have a hard time sort of meeting the dietary needs. Now in the long term, as you just saw, if the models really give us this large increase in extreme heat, it's just not going to be able to farm a large part of what we're currently farming because it's just too hot. So thank you again. I'm happy to look forward to the discussion.
Thanks so much, Wolfram. So our last panelist is Judd Boomhauer. We're going to transition now and talk about wildfires. Judd is an assistant professor in the Department of Economics at UC San Diego and a faculty research fellow at the National Bureau of Economic Research. Judd in general focuses on energy and environmental economics, and today is going to talk about wildfires and the risk of wildfires in the West, but also what those wildfires may mean in terms of pollution to the rest of the country. Take it away, Judd.
Great. Thanks for having me to give the view from out West. So we obviously have seen clear increases in the size, frequency, and severity of wildfires in recent decades. And I think that's become particularly salient to the general public in the past few years. Why? Well, this is a combination of hotter and drier weather due to climate change, a trend that's, of course, just going to continue to get worse, piled on top of increasing development in high fire risk locations and a long history of complicated forest management policy in the Western US. So all of these things act together to create a very difficult situation with wildfire in the United States. So I'm going to talk about a few economic impacts of this worsening wildfire problem. I'm going to omit a bunch of other important impacts, and I'm happy to point interested audience members to sources for those other impacts. But let me start out by talking about structure losses, which is the sort of most immediately obvious impact and the one that we generally hear about whenever there's a severe wildfire event. So this figure is showing you property damages from wildfires over the past 30 years or so. And you can see historically that these damages have ranged from, nothing to several $1 billion per year. Of course, in the last 4 years, we've had some really, really severe events in California. The Camp Fire, the Napa-Sonoma Fire, the Woolsey Fire in Los Angeles. And we've had really terribly exceptional structure losses. And so you can see that the damages here are really driven by these extreme events. And I think there are important questions about the frequency of those extreme events going forward. I have a placeholder dot here at about $6 billion for our losses so far in 2020, but I should point out that we're not completely out of the woods for 2020 yet. Where is this risk spatially? Well, it's really spread throughout the Western United States, but the point that I want to make about the spatial distribution of this risk is that it's extremely predictable. So scientists have done a very good job of telling us where we should expect homes and other assets to be at high risk from wildfire. So we know we have pretty good high resolution modeling of understanding where this risk exists. And it includes very densely populated areas of California. It also includes much more sparsely populated areas like Idaho and Western Montana. I want to also point out some other categories of economic impacts from wildfires that we don't think about as often, but that actually end up being quite significant. So it turns out that the large majority of wildfires are extinguished before they do any damage to property, and that a big share of the cost of the wildfire problem shows up in social accounting, not only as lost property, but also the cost of all of these other things that we do to prevent property losses. So that includes billions of dollars that we spend every year on wildland firefighting. I'll show you some numbers on that in a minute. It includes a lot of money that we spend on fuels management, thinning vegetation in an effort to reduce the intensity of eventual fires. And more recently, it includes really important economic costs from public safety power shutoffs, which is when electric utilities turn off electricity during high-risk times in order to reduce the risk of a fire. That, of course, has very important economic impacts on people who lose electricity service. So this slide is just showing you annual federal expenditure, federal agency spending on wildland firefighting. And the point here is the upward trend. Federal agencies alone now spend several billions of dollars fighting wildfires every year, and this omits important state expenditures as well. The last impact that I wanted to point out is this growing understanding of the economic costs of air pollution from wildfire smoke. So this is we are rapidly increasing our understanding of this impact. We still don't know enough, but we know that wildfire events deliver very large doses of particulate matter pollution to population centers throughout the United States and the rest of North America and the rest of the world. So this is an area where we're working on developing more understanding, but presumably these costs are quite large. So this map is just showing you at a county level how many days of heavy smoke each county experienced between 2010 and 2019. So that's it for me. Thank you, Tamma.
Great, thanks so much, Chad. We've got lots of great questions. I'm just going to start out with one that I'm hoping cuts across these different risks, and then we'll drill into individual questions from the audience. So I think something that comes through really clearly in all of your research, both that you've presented here and in other work that you've done, is that there's really important equity implications from these risks. So who is getting flooded, who's exposed to wildfires, who's also getting protected from those wildfires, and whose incomes are most susceptible to these agricultural productivity shocks. And so I'm wondering if we can talk for each of you, or whoever wants to jump in, about the sources of these inequities. And I think they're probably quite different in these different risks. And then what might be done on the policy side to improve policy responses that address these inequities. So we have a question from the audience about if we have any examples where policy has done a good job here in responding to the risk and taking equity and distributional consequences into account. So whoever wants to jump in first, go for it.
Okay, so I can say from the flood standpoint, we have long-standing historical discrimination in the housing market that essentially has led to disparate outcomes in terms of who lives in the most low-lying areas, especially for inland floods, and so there's a greater level of exposure Post-disaster, a lot of aid is tied to ownership of assets and uses measures like benefit cost ratios and credit scores that are going to lead to greater resources going to those who already have. So there's problems on both ends. In terms of government policy, I think that does well. I think probably the best in terms of disaster recovery is the HUD program, CDBG disaster recovery, or CDBGDR. In CDBG legislation, 70% of the funds are supposed to go to low to moderate income populations. And so I think it's really one of the few programs that has, disparate social impacts as part of its mission.
I'll just tag on to what Eric said. I think the rigidity of a lot of the existing policies is a problem, because it means if you fall into the category that a lot of them were designed for, you're a homeowner, you're up to date on your mortgage, your house is worth enough that you can afford to buy somewhere else, then they might work just fine. If not, they probably don't. And so I think it plays out in interesting ways on the coast, where of course there's sort of obvious linkages with if you want to stay put, the resources you have to stay in place. It also affects actually who can leave safely. And so there are indigenous communities in Alaska that have been trying to relocate as a community for decades and decades, but they don't fall into this category of having $300 houses that they own and they want to move together. And they've gotten essentially no government aid to do that. Whereas, if they're relatively better off communities in New York after Sandy who called up their local representatives and pushed to get enrolled in a FEMA program and could get that payment and move. So you really see it taking place differently in different contexts, whether it means you want to stay put or you want to move.
So I think farmers in a way, as I mentioned, quite protected given the crop insurance. I mean, there's some inequality in that crop insurance can favor bigger farms. So there might be some problem for smallholder farmers that they're not quite as well protected as others. There's also some research showing that even within the United States, migration patterns depend on yield shocks. So if we had sort of longer 5-year intervals where there was a bad yield in a particular county, we see an increase in the outmigration. So there might be some reshuffling on where people move. I think the biggest impact in terms of inequality is sort of outside the US. That we sort of see that food prices can rise. And you might remember between 2005 and 2007, commodity prices tripled. It didn't really impact people in the United States because commodity costs are a very small fraction of what you pay in the supermarket, but it had really large effects on people in Haiti and other countries who couldn't sort of couldn't muster the money for their dietary needs anymore.
I would just add, I think the conventional wisdom on wildfires historically is that this is a problem that affects rich areas of California, Malibu, and that we spend all of this money trying to protect homeowners of coastal mansions in Malibu. And there is some truth to that, but it turns out that this risk is also a really, really important risk in rural parts of the Western United States where income and land values are just much lower. And so the economic impacts of wildfires really do spread across the wealth spectrum. I'm particularly interested in understanding inequities in terms of smoke exposure, though. I think we have lots of reasons to think that health impacts of pollution are particularly bad for vulnerable populations. And I think there's every reason to expect that will be true for wildfire smoke as well. And so that, I think, is an area where we need a lot more work.
Great, thank you, guys. I think another question that has been coming up from the audience and cuts across multiple of these risks is thoughts about rebuilding or relocating and what that might mean for housing affordability. So how do we think about responding to these risks by either relocating or rebuilding assets? And what might that mean for housing affordability, given these inequities that we've just talked about? Flooding seems like an easy place to start if either of you want to jump in.
Yeah, there's a lot in there. I think to me, one of the sort of preceding question before the rebuild or relocate question maybe is kind of having long-term sort of shared long-term expectations for the future of these communities, what they're going to look like in 25, 50, or 100 years. I think a lot of what we see in housing markets, we're rightfully concerned about the extent to which, if or how much housing markets are responding to information about climate change. And I think maybe we sometimes overlook the fact that that person who's buying a $2 million house in South Florida, they might actually be fully informed about climate change. They might just think that the government response is going to be sufficient, that it's fine, right? That the city, the state, the federal government will put in the billions of dollars needed to maintain that community the way it exists. And the discrepancy in that different views on the long-term expectations for a place that I think is a concern that needs to sort of guide approaches to managing this rebuilding or relocation question. I think we're not in a place where we can simply look at the maps and say, this is a place we need to pull out, because we don't know that. That's very much up in the air. That's dependent on our response to that risk. And to make it fair, right, to ensure that what happens is not that the people who can't afford to have to leave regardless of if they want. There has to be some type of coordinated response that's based on some conception of the long-term expectation for that area.
Yeah, I know managed retreat is becoming a really hot topic. And, it's sort of a rational response to increasing risk. But there's some significant questions about the equity of that. There are big differences in capacity of communities to organize, implement these kinds of programs. There's differences in the desires of the community members to do so. And you're already starting from a point where many vulnerable populations are already living in the places that would benefit from managed retreat processes. So I just think that regardless of what program we're talking about, we need to integrate social equity measures into decision-making processes, understanding that these are not just economic decisions, they're environmental decisions and they're social decisions. And we need to, reflect that in decision-making.
I guess to sort of chime in on the same question from the perspective of fire, my sense of the numbers is that at least historically, even in the highest risk places, expected fire damages haven't been big enough to justify abandoning these sunk investments that are represented by existing homes. And so, I guess if you have a pessimistic forecast going forward, you might think that there are some places where you would want to fully abandon existing homes. But I think that the questions are more about where is new development going to happen. And there is a lot of new development in really high fire risk places. And if you were to ask me, should some of that be, not be allowed? I think the answer is maybe, depending again on your forecast for how much worse the fire problem is going to get. But more importantly, I think it's clear that there is a lot that we can do in terms of how we build. And so the affordability questions and the impact questions are going to depend not only on whether we put housing in relatively high-risk places, but also what we do in terms of mitigation. So should we be building housing in high-risk places the way we built housing in high-risk places in the 1970s? I think the answer is almost certainly not. Wood roofs and and houses that are very far apart and neighborhoods that are not thinking about mitigation. But I do think that there are really important things that we can do in terms of resilience that maybe change the picture and make it possible to make at least some of these investments.
Just briefly about ag, we're already seeing that corn is going into Minnesota. So there's been sort of a bit of a shift where things are being produced, and that's just likely to be accelerating. And I guess in the long term, it might have a pretty big influence on certain states and what would happen to employment opportunities in ag.
And Wolfram, I'm not sure if we know this yet, but as we see those movements start to happen, do we have evidence of what happens to the economy in the places as agricultural income moves out? Like, are we seeing income diversification? Are we seeing out migration? Because we think about similar risks, either wildfire or flooding, I think the answer might be different about whether people stay and adapt or whether we actually see migration, which some of your previous work has pointed to.
So we have seen a bit of migration if ag is doing badly, especially of younger people. I guess it's sort of this, I don't want to take over the farm from my family or so. And that's, Richard Hornbeck has shown the same thing during the Dust Bowl. It was predominantly the young people who left, not necessarily the older ones. So I think there's a big discrepancy there. So again, it's a bit weird in the United States is we've either been lucky or there's some studies by Hubers and others that actually think it might be a bit of a negative feedback that as it gets hotter and we apply more irrigation water, there's some initial cooling. We haven't really seen this large increase in extreme temperatures that one might have expected. So there are actually futures, weather futures that you can bet on weather. And so one thing we've just recently shown is if you bet on weather in Chicago, New York, all the big cities, they're basically based on stations at airports. You can basically bet in January about how hot June will be. And people are fully rational and forward looking. They see it's getting hotter, they're pricing it in, it's getting warmer, but we don't see it for the extreme over the ag area yet. So I think in that sense, I don't have an empirical model to sort of really estimate how people respond, given that there hasn't been this big response except for 2012. So 2012 is sort of a harbinger of what's supposed to happen, but we haven't really seen more of that in the last couple of years.
That's really interesting. I think let's stay with ag for a second. We have a couple of questions for you, Wolfram. One is from Saul that links back to our previous panel. So Pete Clino is talking about how innovation and technology was really the driver, is seen as the driver of long run growth and income. And Saul's asking if you see that as true in ag sector. And this is in light of the fact that we haven't seen wage growth in ag in recent years. And you've shown that there's basically no innovations that we see changes in the sensitivity of ag to temperature. So I'm wondering if you can talk about how we think about communities in the US that are mainly dependent on agriculture in light of this idea of long run changes in income.
So I do believe that innovation in ag is very important. And again, there's been this really remarkable upward trend. I mean, it's hard to identify empirically the dependence on prices, given that there's a huge time lag between when you start trials and when they go online. I think there's a bit of a disincentive from crop insurance to innovate against being more resistant to weather fluctuation because the government bails you out because it's not actually fair. It's actually subsidized crop insurance. So as the crop insurance rolled out in the 90s, we actually saw that the sensitivity to weather fluctuation increased again. So that might give sort of a disincentive from a government's policy perspective. I guess the remarkable thing in ag is that at least my experience going to those corn grower association meetings and so forth, that they're very open about sharing their innovations. And in that sense, I don't think any particular one is sort of capturing it's not like one farmer would capture a lot of rents by innovating. It's often like, you know, how you grow, maybe the seed companies capture some of that. So if you correlate, and this is not, I'm not claiming any causation here, but if you correlate like Monsanto stock price and you look at the corn price, they're very much closely aligned. So they might capture some of the benefits, but then they actually have weird incentives because they're, again, such a big company that they might, if you have actually breakthrough technology, it would actually lower the price of corn. But I think the The technological progress is sort of, in the past, it's been done a lot by public investments, and that sort of saved us. And the Gates Foundation is stepping in nowadays to sort of support a lot of it. And I think that's been key. But in a way, it's been so successful that prices are low, and that's, I think, why the workers are not really seeing a big return on it, on those investments.
Great, thanks. I have a question from Yuki, and maybe Eric can speak to as well. You mentioned these communities in Alaska and other communities that are thinking about and considering moving out of harm's way. People are wondering, how fast can we do that? If we have some of these more extreme sea level projections that actually come true, what is the speed at which we can feasibly think we can move communities out of harm's way? And do we have any empirical evidence on when we see this type of relocation, to the extent that this has happened in the past, do we see people being better off or worse off? In the beginning of your slide deck, you mentioned a widening wealth gap after big events. And I'm wondering if there's something about who's relocating and who's benefiting or being hurt by that relocation that may speak to that increasing wealth gap.
Yeah, sure. So there are two sort of different scenarios in the US anyway, as far as our experience has gone so far. The one model in the US is that the local government buys your house, right? They get money from FEMA, and if it's cost effective, they buy your house, and then you can leave, and that property gets restored to open space. That process from the flood event itself to people actually selling their house usually takes a few years. That's the relatively straightforward scenario. If you ask the Alaskan communities, they, I believe, some of them first voted to relocate in 1990. I think as of this summer, about 100 people have been able to move. That's a full community moving together, very different scenario, but obviously that does not bode well for not only the pace, but also just the sort of complete lack of support in the process does not bode well for any type of future movement. In terms of how it affects people, we know very, very little about that, in the sense that when people sell their house to FEMA and move, we don't track them. We very rarely actually know where they go or how their incomes change. There's a interesting study, and I'm failing to remember the person, but in South Asia, where the government essentially offered to help move the people of one village, and the village up the hill from them did not get the offer. And they went back and asked people after they moved what they thought of it. And the people who had moved were materially better off. They had more wealth, partially because of the compensation structure of the relocation, but they were unhappy. They said they hated the new place. They wish they hadn't done it. And then the people up on the hill said that they wished they had gotten the money to move. And so I think it's really tough to, it's really tough. There are absolutely people who want to move, who would benefit from moving, and who don't have the resources to do it. But finding and actually like enabling those people to make that relocation successful is a huge challenge.
Yeah, thanks. And that sort of speaks to some comments that Eric has made about looking beyond, the material well-being itself. And when you're communicating that people are materially better off, but not as happy, I think that's really important to keep in mind. Eric, we have a question for you about that I actually had as you were speaking as well. As we've increasingly better understood flood vulnerability, you've provided evidence that we know who and where are increasingly exposed. We're wondering if there's been a complementary growth in the communication of this vulnerability to stakeholders and to those who are most at risk, and maybe policymakers as well as those on the ground who are facing that risk. And have you seen what the role of that communication might play at the level of individuals or and policymakers? And also this question asker also asks if Judd has any responses as well, if we've understood the risks of wildfire better, has that actually changed what people are doing and what policymakers are doing?
Yeah, I don't necessarily think that, well, first of all, I don't think we have an understanding of how vulnerabilities are specific, like social vulnerabilities are specific to hazards. There's still a lot of real generalized approaches. And that's even within this paradigm where sort of social vulnerabilities are far subsumed under other dimensions. So with respect to communication with stakeholders, I don't think that's happening so much. I mean, the federal policies aren't really structured that way to encourage that. And by stakeholders, that's a really broad thing. I mean, you could be thinking about stakeholders of vulnerable populations who tend to interact with social service agencies like the Red Cross and Habitat for Humanity, probably more than the federal government with disasters. Stakeholders could be government, all sorts of different stakeholders. So I don't really get the sense that communication, especially from stakeholders to policymakers, that direction is happening enough.
So in terms of fires, there are a lot of efforts to communicate risk in high risk places and to encourage responses, self-protective responses like trimming vegetation around your house to create defensible space. We have huge, well, relatively large information campaigns trying to get people to do these things. But I think another thing that we know is that those campaigns are less than 100% successful, right? There's really clear evidence in the economic literature that people don't seem to understand their own financial risk from wildfire. So there are, 3 or 4 really nice hedonic studies that show that my individual risk as a homeowner that I face from the wildfire threat doesn't appear to be accurately reflected in home values. And so that's a consistent result that we see. So the communication, you can interpret that as a failure of communication, or you can interpret that as something else, but the message doesn't seem to be fully received. And that's also true for creating defensible space. And so there's a lot of work to be done to change behavior. And I don't know if just more aggressive communication is the right answer, or if we need to be thinking about different interventions.
Follow-up question, sticking with fires, that I think corresponds to this idea that there's a lot going on and the communication of this risk is really complicated. A question is, how much of the increasing fire risk is actually climate change? And because there's so much going on here in terms of absence of controlled burns, or in California, PG&E taking responsibility for fires. It seems like it's really hard for us to pull apart what is climate change and what isn't. And I'm wondering if you can speak to what we know about that, and maybe if that's playing a role in difficulties of communications of risk.
Sure. Well, first of all, I'm not the right person to definitively answer that question, and there are a lot of people who are working on trying to pull apart these risks as best as they can, but the question is right on that it's a difficult thing to do. And I think the kind of, at least my take on the sensible answer here is that it's a mix of these things, and it's really hard to attribute an exact share of it to climate change, but certainly that the effects of climate change are exacerbating whatever effects were pre-existing from these other drivers. And so there's every reason to think that a warming climate is just going to continue to make this problem worse.
Yeah, thanks. So we've got a couple more minutes, and I just want to ask one more question from the audience, and anyone feel free to jump in. This sort of cuts across. Todd Laporte's asking about institutional capacity, and in particular, what's interesting about his question is, we're talking, each of you spoke about individual types of risk, but how can we think about institutional capacity when there's simultaneous exposure to multiple sources of risk, and there maybe this leads to demand for multiple different types of institutional responses. Has this been studied? Are we focusing too much on one risk at a time? And is that potentially leading to challenges in communicating with policymakers or with stakeholders who are facing a set of different risks at once?
Yeah, I think it's an important point. You know, these hazards are not, you know, independent. We can have places with compounding risks, places with cascading risks, all sorts of modes of multi-hazard challenges. And I would say that for the most part, our programs are not set up for that. But I also say that I don't think we deal with individual hazards well enough either. So I don't know if it's so much of an, you know, an individual versus a multi-hazard paradigm, but we need to invest more in both.
I think this plays out differently at different scales, certainly at the federal level, right? Many events happening all at the same time on top of these slow moving gradual changes that we know are coming. And so surely the capacity constraints there and needing to deal with fires, storms, inland floods, tornadoes, all of those things at once. At a state or local level, you can imagine it playing out slightly differently. I know here in North Carolina, there were two bad hurricanes, I think in 1996 and 1999, Fran and Floyd. And then, and actually, because of Fran, the state emergency management and hazard mitigation capacity was quite high when the second storm hit. And so there was this foundation of understanding of how to deal with FEMA and how to funnel money around that was useful. Since then, capacity has plummeted in those same agencies. And so you could imagine that needing to build up, you know, we need to build up capacity. Maybe it is hazard specific at smaller scales, but we actually need to sustain it over time rather than reinventing it from scratch every time a new event hits.
Thanks, guys. I'm gonna have to cut off the discussion. Thank you all so much for participating. We have a 10-minute break now, and then we'll hope to see you all back here for the rest of the program. Thanks so much.
Hello and welcome back. We're now joined by Robert Litterman. Robert Litterman is the chairman of the Risk Committee at Kepos Capital LP and also chaired the Commodity Futures Trading Commission's Climate-Related Market Risk Subcommittee, which published its report, Managing Climate Risk in the US Financial System, in September 2020. Bob is with us today to talk about how that report came together, its findings, and key recommendations. Prior to joining Kepos Capital in 2010, Litterman enjoyed a 23-year career at Goldman Sachs. Bob was named a partner of Goldman Sachs in 1994 and became head of the firm-wide risk function. He is the co-developer of the Black-Litterman Global Asset Allocation Model. Dr. Litterman earned a PhD in economics from the University of Minnesota and a bachelor's in human biology from Stanford University. Thank you for being here, Bob.
Thank you, Hannah. It's a pleasure to be here. I really appreciate you and the Climate Impact Lab, the Federal Reserve Bank of San Francisco, and the Rhodium Group for organizing this conference and for having such a great group of speakers on such an important topic. It was, well, I should say, I also appreciate that the opportunity to discuss this report, the U.S. Commodity Futures Trading Commission's report, Managing Climate Risk in the U.S. Financial System. It was my honor to chair the Risk Committee, and I'm proud of this report and of the expert team that I led in producing it. In some ways, this report was really quite extraordinary. If you'd asked me at the outset whether we could produce a comprehensive consensus report with this clear call to action underpinned by the extensive expertise of the subcommittee, and with the first recommendation being that the United States should establish a price on carbon, it must be fair, economy-wide, and effective in reducing emissions consistent with the Paris Agreement. And this is the single most important step to manage climate risk and drive the appropriate allocation of capital. I would have thought that would never happen. This was amazing. And this strong call for action was supported unanimously by the committee. Now, many factors led to this success. The credit for the creation of the report starts long before my involvement and certainly belongs to the commission itself, which provided the vision and the bipartisan leadership on this incredibly important topic. And especially to Commissioner Rustin Benham, who as the sponsor of the Market Risk Advisory Committee and who along with the MRAC itself convened a panel of experts on climate risk back in June of 2019, and then agreed to convene this subcommittee to create a roadmap for addressing climate risk in the financial system. The CFTC is not the highest profile financial regulator, but it is responsible for oversight of many agricultural and other complex derivative products, and for that reason deals with some of the more complex risk management topics and perhaps has more of a quantitative bent than some of the other financial regulators. And this perhaps in retrospect makes the CFTC a natural home. Over the second half of 2019, the commission formally asked for nominations and chose the 34 members of the subcommittee. The members represent a diversity of stakeholders, geography and business sectors and expertise. We have investors and asset owners. We have lawyers, quants, scientists, economists, experts in risk management, data, and technology. When Commissioner Benham and I first talked about my participation as chairman, I was surprised and very pleased to hear that the effort was going forward. I agreed to lead the subcommittee, and we discussed 3 issues that I think led to the success. First, it was a risk committee. I've sat on many and led many risk committees over the years at Goldman Sachs and elsewhere, and risk committees tend to be very serious and focused. And when there are risks that need to be addressed, there is an urgency and hopefully a governance structure that ensures that those risks are addressed expeditiously. Secondly, we had a broad mandate. There was recognition by the CFTC that it could not address climate-related risks on its own. Our mandate was to make recommendations to all of the participants in the financial system. And in fact, because of the fundamental problem causing climate change and the associated risks, is that the lack of appropriate incentives, which is an issue that can only be addressed by Congress. Third, the commission asked for a high-level consensus report that should represent the expertise not only of the individual members, but of all of the expertise residing in their organizations as well. We met for the first time in November, that is a year ago, introduced each other and talked about principles of risk management, and also agreed that we would try to find consensus. We also talked about the issues we needed to confront, such as pricing carbon and the disclosure of climate-related risks. We began the discussion of topics to be covered, which evolved into a detailed outline. From December through February, we broke into work streams and began writing the various chapters. And then as the COVID pandemic forced us to work virtually, we started monthly subcommittee calls with work streams meeting more frequently. Throughout this process, I worked very closely with David Gillers, Commissioner Benham's chief of staff. He's really been my co-pilot in this project, and his help was incredibly important, kept everything on track. By April, we had a first draft. We went through multiple rounds of feedback and revisions to the report based on thousands of subcommittee member comments. We elected Jesse Keenan and Leo Martinez-Diaz as co-editors and Stephen Mock, our youngest committee member, as an associate editor. And throughout this period, I have to admit, I was not at all confident that we would reach consensus. But we just kept pushing forward. Leo, Jesse, and Stephen in particular led the process through which we negotiated changes in wording, other edits, tone, clarity of thought throughout the chapters. When we scheduled the vote in early September, and there was a unanimous support at that vote, we were virtual, but there was a collective sense of accomplishment. And someday, hopefully soon, we'll be able to get together and have a toast. There were compromises, and of course, no one of us would have written the report the way that we did, but we all were ready to support it, which is why it is such an important endorsement of these recommendations. Now, let me go through the report very briefly and talk about some of the important things that we noted. First of all, in the executive summary, climate change poses a major risk to the stability of the US financial system and to its ability to sustain the American economy. This reality poses complex risks for the US financial system, and a major concern for regulators is what we don't know. The central message of this report is that US financial regulators must recognize that climate change poses serious emerging risks to the US financial system, and they should move urgently and decisively to measure, understand, and address these risks. Achieving this goal calls for strengthening regulators' capabilities, expertise, data, and tools to better monitor, analyze, and quantify climate risks. It calls for working closely with the private sector to ensure that financial institutions and market participants do the same. And it calls for policy and regulatory choices that are flexible, open-ended, and adaptable to new information about climate change and its risks based on close and iterative dialogue with the private sector. At the same time, the financial community should not simply be reactive. It should provide solutions. I won't go through the report and its recommendations in detail, but I urge you to read it. And in some of the chapters, let me just highlight the foreword, which I wrote. We note that a fundamental flaw in the economic system lies at the heart of the climate change problem, the lack of appropriate incentives to reduce GHG emissions. No discussion of climate-related financial risk management can begin without focusing on this fundamental market failure. And in the introduction, which is an introduction to finance in the face of climate change, we note that limiting greenhouse gas concentrations to a level consistent with a warming of well below 2 degrees Celsius above pre-industrial levels, the core objective of the Paris Agreement on climate change, is essential to achieve a reasonable probability of avoiding irreversible catastrophic impacts. In the chapter 2 on physical and transition risks, we note that climate-related physical and transition risks are already impacting or are anticipated to impact nearly every facet of the US economy, a broad cross-section of markets, products, instruments, and services. How material these climate-related risks will be varies depending on time horizon, geographic region, and segment of the economy, as well as on climate mitigation and adaptation actions. In chapter 3 on implications of climate change for the US financial system, our understanding of how climate change and societal responses to it will affect financial markets, institutions, and systems remains in its infancy. It is clear, however, that climate change presents a uniquely complex set of financial risks for 3 reasons. First, climate change will affect multiple sectors, geographies, and assets in the United States, sometimes simultaneously and within a short time frame. Second, climate-related financial risks are large, but remain uncertain because climate change is shifting fundamental environmental parameters, pushing planetary systems to new extremes. Third, the impact of climate change on a wide range of variables involves tipping points and what economists call discontinuities, situations where conditions can remain stable for a long time, but then deteriorate sharply and suddenly. In chapter 4 on existing authorities and recommendations for financial regulators, we note that regulators in an ideal world should be able to perform 5 important functions to address climate-related risks. The 5 functions are to identify and provide opportunity of physical and transition risk at a systemic level. I said opportunity to provide oversight at a systemic level to ensure that financial institutions, dealers, and other key market actors can monitor and manage climate risks, ensure that financial institutions, dealers, and other key market actors have the capacity to absorb climate-related financial impacts without causing system-wide or regional disruptions. Fourth, to ensure that investors, customers, and counterparties have adequate information to understand material climate risk. And finally, to identify and address climate-related operational vulnerabilities in financial market utilities and critical service providers. Existing legislation in general provides US financial regulators with broad and flexible authorities to perform the key functions outlined here. However, regulators are not utilizing their authorities and tools to effectively monitor and manage climate risk. Further rulemaking, and in some cases legislation, may be necessary to ensure a coordinated national response. In the 5th chapter, a closer look at climate risk management and data, we asked 3 questions. How can a more robust climate risk data and better analytics be developed? And how can financial institutions continue to build their capacity to utilize climate analytics to inform business decisions? What kind of analysis should be undertaken to complement existing risk management? And how can climate-related risk analysis support and strengthen risk management across different parts of the financial system? In chapter 6, a closer look at climate scenarios, we took a closer look at the importance of scenario analysis in climate risk management. Scenario analysis is a systematic process for making strategic decisions in the face of uncertainty. It has a long history of use in military, political, and corporate planning. Climate scenarios, as advocated by the Task Force on Climate-Related Financial Disclosures and others, are used by researchers, policymakers, and increasingly corporations to analyze potential climate-related futures, including the economic, social, and environmental implications of achieving different temperature and emission goals. In chapter 7, a closer look at climate risk disclosure, we talk about the response to market participants' informational needs. The number of entities disclosing climate-related information has increased, and the quality of disclosed information has improved over the past several years. Yet, despite this progress, the information disclosed falls significantly short of what capital market actors need to adequately integrate climate risk into their decision-making. Given the inadequacy of the current climate risk disclosures, U.S. regulators should build on their global counterparts' models and issue rules for climate risk disclosures. They should monitor the rules for effectiveness. Such action by regulators would be directly responsive to the market demand for enhanced climate disclosure. And chapter 8, which was a closer look at financing the net zero transition, we highlighted a selection of many measures that regulators, financial institutions, and market participants can adopt to catalyze climate-related investment. Once carbon pricing is adopted, these measures will be equally, if not more important, in facilitating orderly shifts in investment decisions. While some financial products are already available to assist market participants interested in investing in the transition, this chapter focuses on the scale of investment needed and the gaps where further institutional effort is necessary to facilitate the development of climate-related financial products and services. In conclusion, we noted that to be sure, the road will not be straight. The evolution of climate change and its impacts is highly uncertain. Climate-related data, models, and scenario planning remain at an incipient stage. Therefore, the process of strengthening climate risk management will be inherently experimental and demand constant learning and innovation. Persistent evaluation, consultation, and course correction will be par for the course. So with that, let me return it back over to you, Hannah. I'd be happy to answer some questions from you or the participants.
Excellent. I wanted to come back to the theme that you mentioned there about continued learning, and noting that we have plenty of researchers in our audience today. Could you, looking across the landscape of research on this topic, can you give us your perspective on what kind of research the regulatory community needs from the academic community? Where are the gaps for policymakers and regulators?
Sure. Well, as we said, the research in this area is really at an early stage. So there's a lot of gaps. I would say, from my perspective, the biggest issue is that we have risk management at many different levels of aggregation. So you have individuals themselves, of course, that may have homes that are at risk, but you have corporations, which operate in different sectors of the economy, different localities, and their climate-related exposures are going to be very local. It'll depend on what business they're in, and so it's kind of bottoms up. But you have also climate risk management that's necessary by investors, by asset owners, and the financial regulators as a whole who are looking at the systemic potential risks to the system. So how do you get that bottom-up data to be decision useful for those who are trying to manage systemic risk? it's very difficult. And I think that's where we need a fair amount of work. I would say that my suggestion for approaching that is to ask the question at each level, is my risk management and is my business plan or my portfolio aligned with a rapid transition to a net zero economy? Sometimes we talk about alignment with a 1.5 temperature or a 2-degree temperature or alignment with the Paris goals. These are all basically asking the same questions, but the answer is going to depend on what kind of entity is asking the question. So the climate-related risk factors are going to be very dependent, and then aggregating those is going to be difficult. So I think that's really where we have a lot of work to be done.
Can you speak a bit to the role of federal agencies as one of the entities that could conduct research into climate-related financial risk? And then relatedly, where do you see the private sector playing a role in research?
Sure. Well, just as the financial regulators, including especially the FSOC and the Fed, the SEC, the CFTC, they all have capabilities to do research, and they've been doing financial research for decades. They've been doing a good role at that, a good job at that. I think they have an important role to play with respect to climate-related research as well, especially in terms of leading and coordinating and funding that research and understanding the implications of that research. So I would say yes, absolutely, a very important role. And you asked about the private sector as well. And absolutely, the private sector, I think, has to take a lead on this. And as evidenced by the expertise that you saw in the climate-related subcommittee, there is a tremendous amount of expertise out there in the private sector, and it's continuing to grow very rapidly right now as a lot of institutions, a lot of investors, asset managers have become, in just recent years, very focused on this topic.
Thank you. I want to turn to one of your favorite topics, carbon pricing. You are serving as the co-chair of the board on the Climate Leadership Council, which has put forth a carbon dividend plan. I wonder, from your view, what are the prospects for carbon pricing legislation in the next Congress?
Well, legislation remains very uncertain, I would say, but I think for sure we're going to have a conversation, and that's the first start. I mean, hopefully there'll be a debate, and I hope and expect it's going to be a bipartisan conversation. That's one of the things that's been missing in the past, is really bipartisanship. And climate change is very much a bipartisan issue. I have no idea what political party any of the members of the subcommittee are on. We never discussed that. And I would hope that the climate leadership plan, which is bipartisan, will be introduced in the next Congress, and that will get enough traction with moderate Republicans that the leadership of the Democratic Party will lean in on a bipartisan approach. And if so, I think there's a good chance that we will have success.
Let's talk a little bit about lessons learned from other countries. The U.S. is admittedly a laggard in these efforts to address climate risk. What are some good examples of leadership that the U.S. could draw from?
Sure. Well, I think if you do a search, you'll find that we refer to the NGSF in this report something like 50 times. I mean, it was very clear to the subcommittee that there is international leadership and that we need to participate in it. So that's one of the themes that you'll see throughout our report. In terms of countries, you know, I hate to name individual countries because there's so many, and I don't want to suggest that some are, you know, so far ahead of others, but there are certain leaders. France, for example, has been very forward in terms of the incentives that it has given to reduce emissions, mandatory disclosure, and other types of things. The UK and the Bank of England have been right up there in front in terms of leadership with the financial regulatory authorities and scenario analysis and designing stress tests. So I would say the Europeans in general have been ahead of the US. There's lots of examples of that.
Thank you. I guess this one would be more from your experience in the private sector and your interactions with investors. But I wonder, is it still hard to convince the investment community on the existence of climate risk?
No, you know, I haven't met one person in the financial community. Yeah, some people think it's more serious than others. Sure, certainly you could say there's a diversity of opinions about that. But is it real? Is it caused by humans? Is it a risk management issue that needs to be addressed? Everyone agrees on that, and we agree on so much else. I think, very surprised, as probably were most of the members of the committee, on how much we agreed on. We, you know, we were given the mandate to try and come up with a number of recommendations. I don't think anyone thought we would come up with 53 specific recommendations. So there's a lot of things we do agree on. And then when you talk to investors around the world, I guess up until maybe 5 years ago, it was rare to have a big institutional investor think of this as being top of mind. Today, I think every big institutional investor is thinking of it as top of mind, and in fact, requiring taking steps. So you have an awful lot of investors out there who are all of a sudden saying, okay, what do we need to do to align our portfolio with a rapid transition to a low carbon economy? I would point out, you know, Harvard University Endowment made that commitment just last year. I think Stanford did as well. You see an awful lot of pension funds and other institutional investors who are long-term investors and who recognize the climate risk and responding to it and aligning their portfolio is all something that they need to pay attention to right now.
Thank you. So we have about 5 minutes left, and I do want to work in some questions from the audience. Could you talk a little bit more about the Climate Leadership Council's specific carbon dividend approach, and explain what some of this person is asking about the pros and cons of that approach?
Okay, well, you know, the Climate Leadership Council was started by Ted Halstead. He was a visionary who had this idea of a bipartisan approach, and he went to George Shultz and Jim Baker, and they're two, you know, leading lights of the Republican Party, you know, and they came up with a plan that had 4 planks in it. The first one, of course, is to have a price on carbon, and to have an effective price, and one that would achieve the goals of the Paris Agreement. They also recognize that you know, there may be some other regulations that could be displaced by this. So regulatory rationalization, I think we would call it. And they also recognize that what you do with the revenues from a carbon plan is important. And so they address that by suggesting that it be a dividend plan. That is, that it provide a dividend on a per capita basis to all Americans. So that what that does is it makes it a very progressive plan. We've done research suggesting that something like 70 to 80% of people would be better off. And of course, it's the people who use less energy themselves. So it tends to be the richest part of the population that's poorer, that's made less well off, especially the upper 1%, which emit by far a larger percentage of the emissions than on a per capita basis. And finally, we recognize that we need to coordinate and create globally harmonized incentives to reduce emissions, and therefore a border carbon adjustment is included in our plan. So those are the 4 planks. They're really the key issues that have to be addressed when you try to put together a carbon legislation. And the way we achieved or came to that set of components to the plan is that we brought together what we call a group of founding members. And this included a number of experts as well as corporations. Our founding members have been meeting quarterly over several years and agreeing to the details of this plan. And so it has really been quite well looked at by stakeholders throughout the economy. And our founding members, I highly recommend that people look at it. It ranges from ExxonMobil on the one hand to the World Wildlife Fund on the other. So similar to the CFTC report, we have a wide, diverse range of stakeholders, but in particular with heavy representation in the sectors that will be most impacted, such as energy and power and automotives and so on. Banks are there, insurance companies. So it's been very thoroughly vetted and is definitely ready to be discussed in Congress. I would also point to the fact that we got something, 3,500 economists to support this plan. It's hard to get 6 economists to support any plan. And this was a detailed plan. It wasn't just, put a price on carbon, but it was including these, this is how to use the revenues, this is how to do this, border carbon adjustments and so on. That was pretty remarkable. And including among those economists are, folks like Janet Yellen, the new Treasury Secretary. And so it's something that I think we're going to get a lot of support and it'll be taken very seriously in the coming Congress. So I'm very optimistic about it.
Time will tell. And I just have one more quick question. This is related to a specific recommendation from the CTFC white paper. What would the ideal climate finance lab look like that's described there in terms of public-private partnership?
Well, I think the main thing that we need is to have research and funding for that research and create a set of ideas that can then be tried out. So I think the idea of a lab is really a funding mechanism for innovation in the climate space. And I'm sure there's others who have worked on and worked in things like energy innovation labs and so on that would have a better idea of exactly how it could be structured and successful. But that's certainly one of the areas we need a lot of innovation, a lot of trial and error, and this is going to be really an iterative process. The other thing I'll point out, and we mentioned this in the report as well, is that while there's an awful lot of private sector research going on and firms that are in the business of gathering data and providing analytics and support, that there's a lot that could be done, I think, in a way that creates public good. So we should probably have a open source platform in which we can have data and analytics, examples of scenario analysis that can be used by everybody. So I think there's both room for private innovation as well as a public data platform. And I'm working with the Linux Foundation on something called OS Climate to try and build such a open source platform. And we have a lot of support from private industry on that as well.
Thank you so much. I think we'll have to wrap it up there. We appreciate your perspective and your time with us today.
Thank you, my pleasure.
Next up is our third and final panel of the day. We've explored climate risk through the lens of macroeconomics, its magnitude and its implications for growth. And we've learned more about where the regional risks are most concentrated. This panel is about solutions and specific recommendations for regulatory and policy responses. It will be moderated by Glenn Rudebusch, Executive Vice President and Senior Policy Advisor in the Economic Research Department of the Federal Reserve Bank of San Francisco. Glenn has agreed to steer this panel on managing climate risk and also incorporate some of his own valuable research insights into the discussion.
Thank you, Hannah. It's great to follow Bob Litterman in all areas, and I again applaud his work with the CFTC. That's a great report, and really I think sets a foundation for policy moving forward. This academic panel is on managing physical risks, in particular to the U.S. financial system, but physical risk in general. We've got three great speakers, and our first speaker is Lint Barrage. Lint is the Assistant Professor of Economics at the University of California in Santa Barbara and a Faculty Research Fellow at the National Bureau of Economic Research. Her research investigates how environmental processes and policies affect macroeconomic outcomes and human welfare. She brings a multi-methodological approach to this agenda, combining tools from different fields in order to leverage new data, empirics, and theoretical advancements. Lynn, we've been interested in your insights.
Excellent. Thank you so much, Glenn. Can you see my screen?
Yes.
Wonderful. All right. So we saw in the previous panel that climate change poses a significant physical risks to U.S. housing markets. And in the work I will describe today, it studies the role that risk information and beliefs play in how these climate impacts will unfold. Asset prices generally depend critically on beliefs about the future. So in an ideal world, if everyone was perfectly informed about flood and climate risks, we would expect housing market to already reflect this information, so that safer homes fetch a safety premium and vulnerable homes are sold at an appropriately sized discount, thus providing proper incentives, for example, for new housing construction to favor safer areas. But in reality, the US market response to climate risks has been more complex. And in particular, there's a number of empirical studies that now suggest that risk capitalization is not yet complete. So in the work I will describe today, my co-author and I first conducted door-to-door survey campaign in Rhode Island to better understand households' flood risk beliefs and how that affects their housing choices. We then developed a quantitative model of coastal housing prices under different future risk and belief scenarios. The central, I think my screen's cut off. Let me just, apologies for the. So, apologies for the technical difficulties. So the main takeaway from our survey is that we find significant heterogeneity in flood risk beliefs, and in particular that those who live in high-risk FEMA flood zones are actually less worried about flooding than their neighbors who live slightly further inland. So in this graph, we have the distribution of flood risk perceptions or worry from a scale of 1, not at all worried, to 10, very worried, by in pink flood zone residents and white non-flood zone residents that live slightly further inland in the same communities. And in our sample, 40% of those who live in high-risk flood zones tell us they are not at all worried about flooding. Now, this differential worry does not appear to be driven by differences in perceptions of damages or FEMA assistance in case of a flood event. We also find that those who live on the coast have significantly lower, the majority have lower perceptions of the numerical flood risk to their home than an inundation model would suggest. That being said, there is concern about flooding. We see that those who have experienced a flood in the past become more concerned about flooding in the future. And we also see that those who do live on the coast who are very worried right now are 3 times more likely to tell us they plan on selling their home within the next 5 years. To gauge the potential implications of these belief differences, we simulate housing market outcomes in Bristol County, Rhode Island as an example, as a case study. And what we find is that accounting for misperceptions of flood risk significantly increases the future home price declines that are yet to come due to sea level rise. So for example, comparing an ideal world where everybody is perfectly informed, we see that accounting for the fact that even just 35% of the population might underestimate flood and climate risk increases the projected home price declines due to sea level rise that are yet to come in a high emission scenario by about 20 percentage points. I should stress this is an illustrative number, but it highlights the qualitative point, which is robust across scenarios. So to summarize, misperceptions of flood and climate risk in the population can contribute to the overvaluation of risky assets, housing in particular, and thus potentially contribute to climate bubble risk and delay market adaptation responses. So this panel, we're going to talk about solutions. And I think one of the most salient policy implications of this work is it highlights the importance of accurate and forward-looking risk information for the stability and efficiency of housing markets. So FEMA provides flood maps for many communities in the United States. Those are a vital resource, but they're often out of date, they're backwards looking, and they only have a coarse delineation of flood risk. There's some exciting innovation in this space. For example, the First Street Foundation has developed a tool where for an increasing number of homes across the United States, anyone can look up information about flood risk, including forward-looking projections. But of course, and this was discussed earlier as well, better information does not automatically lead to more accurate beliefs. So there's also a lot of room for improvement in flood risk disclosure laws, as maybe we'll get a chance to discuss later. Last but not least, this work also has implications for national flood insurance policy reform, program reform, where real risk pricing and better enforcement of insurance mandates could, in theory, ensure that risks are properly reflected in markets. Now, that kind of reform also has well-known distributional concerns that have to be addressed, but the trade-off is could help mitigate bubble risk. And I look forward to our discussion.
Thank you, Lind. Our next speaker is Ricardo Correa and he's the Deputy Associate Director in the Division of International Finance at the Federal Reserve Board. His research interests include international banking, financial stability, international finance, and corporate finance. Ricardo is a member of the International Banking Research Network. Ricardo, the floor is yours.
Thank you so much, Glenn. I hope you can hear me well and that you can see my slides. Thanks also to the other organizers for inviting me to present at this panel, which looks very, very interesting from all the perspectives we're gonna observe. So first, I'm gonna tell you a little bit about what I'm gonna talk about today. I'm gonna talk about climate change, natural disasters, and loan pricing. As opposed to Lynn's work, I'm gonna focus more on the corporate side rather than the housing side. And I'm gonna give you the typical disclaimer. These are my views. They do not represent the views of the Federal Reserve Board or the Federal Reserve System or any of its staff members. So this is based on work jointly done with IHE, Christoph Herfer, and Orlel. So this is a preliminary working paper. So of course, in an academic sense, this paper hasn't been peer reviewed yet. So I give you the second disclaimer, which is these results are of course subject to change when it goes to the peer review process. But I think we're getting something different that I think it's worth sharing in this panel. So as Lynn mentioned, there's a lot of research on understanding what are the effects of climate change on long-term assets, such as real estate, in some cases equity as well. There's mixed evidence there, as noted before. There's also, in particular, some focus on some debt markets as well. For example, municipal bonds, which are longer dated. So they're probably 10 or more years on average. I want to focus on, or we want to focus on a segment of the debt market that is more short-term in nature. And so this is going to help us assess whether climate change is already being priced in shorter products that have shorter maturity. So I'm going to focus on syndicated loans. On average, syndicated loans have maturities of 4 to 5 years, and these are mostly focused on the corporate sector. So we want to assess what's the impact of natural disasters on corporate funding costs through the syndicated loans. And we want to assess whether investors, or in this case, banks who originate these loans, are pricing some degree of change in the intensity and the strength of some of the natural disasters that some of these firms are facing. So we already have a hint about some of the information that banks are incorporating in the risk management practices. So we did a quick survey of 10K filings for the largest banks in the US. And a lot of them mentioned that they're worried about climate disasters, and they're noting, and some of them, or the majority of them, are also noting that there's a worsening trend in this climate and this natural disasters. So they, in some cases, they note specific disasters when they talk about these issues. And there's this quote from one of the filings from PNC, where they note that the climate change may be increasing the frequency or severity of adverse weather conditions, and this may affect the credit worthiness on the part of some customers or in the value of asset securing loans. And this information is also being corroborated by other surveys that have asked banks whether they're incorporating changes in their risk, in their loan pricing models to incorporate some of these climate change features. There is still not a full-fledged coverage of this type of risk in these models, but some of these banks are moving in that direction. So if we observe like changes in the way they price this risk, we should have observed some effects on the prices or the rates that or spreads that the borrowers face. So how do we do this? I mean, this is a complicated problem because first, as was noted earlier, these are short-term dated notes or loans. And we're talking about an issue that is going to become worse in the future. So how we wanted, or how we try to tease out the effect of this question about lenders' expectations about severity of disasters is to look at the impact that hurricanes in particular have on the rates paid by different types of firms that are either directly or indirectly hit by these hurricanes. So for example, in this example, we have a hurricane that it's going towards New Orleans, and there's a firm in there, firm B. That firm is going to be directly affected by this hurricane, but that's not exactly what we want to capture, because here this firm, the effect of the hurricane on this firm is going to compound to affect both the direct effect of the hurricane, and second, what the bank thinks about the severity of hurricanes in the future. So what we're going to do is to look at the firm A instead. So firm A is located in an area where it has faced hurricanes in the past, but it's not going to be directly affected by this hurricane. So what we want to capture is the spread that the bank here charges to firm A relative to firm C, which is unaffected by the hurricane. So that's going to give us a sense of what is the perception that these banks have on the change in the intensity and the strength of this particular set of natural disasters. So what do we find? We find a few things. First, the increasing severity of natural disasters. In this case, we focus mostly on hurricanes, but we also do a comparison to other types of natural disasters. They're indeed being priced in the corporate loan market, which was surprising to us because of the reasons I mentioned at the beginning. Second, we find that this effects on loan pricing are significant. So the effect that the spread that this indirectly affected firms are being charged after a hurricane hits in a particular year, it's higher than the spreads that the non-affected firms are paying in that particular year, and coming from the same bank, so controlling for other factors. And we also find that in the secondary loan market, these effects are even stronger. So you have two types of participants here. The first line of participants is the bank. The second part of the participants are those that participate in the secondary loan market. This could be two different types of participants, and they're both pricing the effect of this particular natural disasters. And I think interestingly, we also find that there's an attention channel. So the pricing is actually higher after climate change. It's more salient in the news, and investors, or in this case, banks, are more aware of what's going on in terms of trends related to climate change. And we focus, for example, in those years, in the 12 months and 2 years after IPCC reports are published, and we find that actually the effect on this indirectly affected firms, it's even on their spreads, it's even higher in those particular points in time. As I mentioned before, we control with for a bunch of other things, and we find that our results are robust. So what are the lessons learned from this type of research? So the first lesson, of course, is that parts of the financial system may already be pricing these instruments that are shorter in duration through the effect of natural disasters, or their perception about the strength of these natural disasters in the future, and also their frequency. I think further work is needed to assess whether this pricing is temporary or permanent. So whether they are indeed changing their credit risk models to incorporate these features, or whether this is just some transitory effect that is driven by this attention factor. The third lesson that we learned is that there's good data on natural disasters for the US, but when we wanted to expand this, for example, to a global type of analysis across countries, we saw that there were a lot of differences in terms of how different jurisdictions are capturing the cost of natural disasters. So given that climate change is a global issue, I think it would be useful to have some type of some way of homogenizing how we're capturing this type of data, so that we can do global studies in this regard. And the last lesson that we learned from this research is that we do need better data to assess the exposures of both banks and firms to climate-related risks. So here, for example, our proxying for exposures to these hurricanes is indirectly using other sources of data. So there's no specific data that tells us this firm is exposed to natural disasters. So we have to go indirectly to assess those risks. There's work in this area that perhaps we can discuss later, but I think that's one of the areas where there's some room for improvement as well. So I'm going to leave it there. Thank you.
Thank you, Ricardo. Our final panelist is Carolyn Kowski. She's Executive Director at the Wharton Risk Management and Decision Processes Center at the University of Pennsylvania, where she also directs the Policy Incubator. Carolyn's research has examined multiple aspects of disaster insurance markets, the National Flood Insurance Program, federal disaster aid and response, and policy responses to potential changes in extreme events with climate change. Carolyn was a member of the National Research Council Committee on Analysis of Costs and Benefits of Reforms to the National Flood Insurance Program, and is a visiting fellow at Resources for the Future. Carolyn, thank you for joining us.
Great, thank you. Can you hear me okay?
Yes.
Great. It's wonderful to be here. This has been such a fantastic conversation today. So I'm going to do something a little different. I don't have slides. I'm going to share some observations from research and policy work that I've been involved in on incorporating climate risk into markets. So we know our markets are failing to price climate risk. And of course, as just discussed, the first and most important thing that could be done to help reduce all climate risks is to put an economy-wide price on carbon. But we also need to make sure that the specific risks of changing extreme events are considered in markets. And when we fail to price these extreme event risks and fail to provide sufficient information to market participants, then future losses do not influence today's decisions, which can lead to too little investment in risk reduction, and people can make suboptimal decisions and capital not be directed optimally. But when it comes to harnessing market forces to try and build climate resilience, I think it's going to take multiple policies across different scales and different regulatory bodies. So in my few minutes, I wanted to build on the other panelists and just offer a few observations on three particular markets: insurance, mortgage, and housing markets. So let's start with insurance. People often look to insurance markets to price climate risk in the housing and mortgage markets. And insurance, definitely has an important role to play here, but there's also some challenges that it's worth being aware of. So first, lots of people don't have disaster insurance, and insurance can't provide information or price signals if people don't buy the product, right? As an important side note on that, what really concerns me about the lack of disaster insurance take-up though, and this is a different conversation, but there's now a robust body of research that I recently reviewed that shows that people recover better and faster if they have insurance. So the disaster insurance gap is leaving many people struggling post-disaster. But coming back to insurance more as a signaling device. So second, insurance is not a good tool to signal risk over many years because insurance is typically a one-year contract. So it absolutely should be reflecting today's risk and all the climate impacts we've seen to date, but it can't price future risk very well. And we need to know what the risk is 5, 10, 20 years down the road for these longer term decisions. So because of this, we're going to need other tools to communicate how costs are going to increase over the life of a structure. Insurance company. So what do those policies look like? Well, insurance companies are understandably unwilling to produce future price trajectories, as nice as I think that would be, but much of the CAT modeling could be harnessed to project average annual losses for properties to show how the cost of occupancy might increase as risks grow, for example. Several local governments have now started to adopt policies that require a climate analysis before they permit new development in certain risky areas. So I think these are the types of tools that could be used along with risk-based pricing for insurance. Which brings me to my last point on insurance. So for reasons we don't have time to really detail right now, but I'm happy to talk about offline if anyone's interested, disaster insurance is difficult for a fully private market. So governments have intervened in disaster insurance markets here and around the world. But that means that prices and policy terms in these markets are subject to other political goals, notably affordability, right, which often leads to cross subsidies from low to high risk properties. And it's also important to stress that insurance markets, both public and private, are getting even further upset and stressed themselves right now with climate change. So while we need insurance to help us adapt and have financial resiliency in the face of these extreme events, those very extreme events are undermining insurance in the first place. You can just look at the recent dynamics with wildfire that are worrying people in California. So my bottom line point is that what we're dealing with are public policy questions about when and how we have public sector intervention in these markets in a way that can advance social goals instead of undermining them. And to come back to my first aside, as part of that policy, as we move to have our insurance programs accurately reflect today's risk, which is an important goal, and I should say one that's now deeply underway at the National Flood Insurance Program. And if anyone wants to talk about price reform rolling out next year in the NFIP and Q&A, we could do that. But in addition to that, we need to couple those changes to means-tested assistance so that everyone can have the financial resilience they need to disasters. And for reasons we could talk about, insurance is even more important in my mind for lower income households who don't have access to other types of recovery, and yet they're the ones who struggle to afford it the most. Okay, now I'd like to say a word about mortgage markets. There's been increasing media and scholarly attention to this, right? Specifically in coastal mortgage markets. And so I just want to share a couple observations to just add to the conversation. First, the impacts from climate disasters on mortgage outcomes to date have been fairly modest. So for example, in a recently published paper with 2 colleagues at Fannie Mae, we looked at the impact of Hurricane Harvey on loan performance and found that while mortgages definitely perform worse as damage increases, very few loans actually fully default. And this is partly due to the protective value of flood insurance, which we were able to quantify, but also the role of aid and forbearance programs and loan modification programs that get people current on their mortgage again. Now, those aren't costless, right? They are still costly. But that dynamic's been true for other big disasters too. They haven't necessarily led to, massive defaults or systemic problems. Now, the keyword might be yet. And I think the most important risk to think about is maybe not so much the sort of damage to particular structures from a strong disaster event, but what happens when the prices in entire communities start to decline and not recover because of growing nuisance events and sea level rise. And I think that's the type of event that could prove much more systemic in these markets, which brings me to my next point. So even forward-looking lenders who are thinking about the possibility of these impacts and these risks growing, I think are a little bit stuck right now in their ability to price for climate risk. So in some interviews we did on this topic, we found that many lenders would not do things like require more borrowers to have flood insurance beyond the congressional mandate, or actually start pricing climate risk in loans for two reasons. The first is a first mover problem. So if they start making those types of requirements, borrowers are just going to go across the street to their competitor instead. So there has to be a coordinating mechanism for the market. And the second concern that we heard raised was that particularly pricing climate risk might be seen as a violation of fair lending. So in my mind, we really need regulators to take the first step and to enable and also push the GSEs and lenders forward on this topic. That said, Ricardo might have comments on whether there's been some actual pricing in residential mortgage markets that I'm not aware of yet. So then just to quickly wrap up, a quick word on climate risk in housing markets. And Lynn already discussed wonderfully how much climate beliefs could impact housing markets. And there's been lots of studies that show that home values do decline in areas where the risk is known. And I think the challenge now, which is starting to be overcome, but is still persisting, is getting that good information, as she talked about, to buyers to incorporate into their decisions. And it has to come early, it has to be understandable and specific. And I'm optimistic we're getting there. So I'm on the board of the First Street Foundation, she mentioned them too, and they've helped integrate flood risk into Realtor.com. And I think that's the type of thing that can really help these markets, because then the information's available right when consumers are starting to think about where they live. But we also need this for other perils, and there's other more specific things that we need. So we need disclosure, for example, around repetitive loss properties. That's not being done. We could talk about what that is specifically, and information on home mitigation measures and the protection that they provide so that buyers can value that protection. Okay, so those were my reflections. I want to end with just one little note of caution, which is that while I've used my time to talk about the need to price risk, I don't think that's sufficient. We're going to struggle with myopia and short-termism, lack of awareness, entrenched interests, perverted incentives, under provision of public goods, grappling with uncertainty, right? There's all these challenges. And in the face of that, I think we also need to do which is somehow seeming to be the harder stuff of directly regulating land use in risky areas, adopting stronger building codes, and protecting coastal ecosystems outright. Okay, thank you.
Thank you, Carolyn. That is a daunting list. Why don't I open it up to the whole panel? If you have comments, questions for each other, let's start with that. Any thoughts on any of the other presentations that you heard? I was going to mention that several of you talked about natural disasters, extreme events. That's a natural place to start. But I'm also wondering about the adverse chronic trends, and Carolyn touched on that. And that seems to be as worrisome a development as well, and whether how can you apply some of your techniques, or how can you make progress in pricing those trends, as well as the adverse, as well as the natural disasters, the extreme events? Feel free to go first.
I guess I'll just step in by saying I think that some of those chronic trends are really important. And I think one of the questions we face, if we're thinking about, say, sea level rise and changing flood dynamics in coastal areas, is to how to start incorporate that information now so that we can have a smoother transition. Because if we can't have markets start adjusting today, then I think the concern is that what we're going to be faced with is the sort of catastrophic post-disaster changes. And that's worse for everybody, right? Those are very harmful for people. So I think that's the real challenge, is how to get more anticipatory, how to incorporate these future information on risk today.
So, go ahead, Lynn.
No, go ahead.
So I think that was an aspect that we wanted to get at with this type of research, because we wanted to assess whether banks were forward-looking and thinking about what could happen next. I mean, if these trends continue to be like this, should we start pricing these loans differently? So I think in their design that we specified, we wanted to get a little bit of those trends. Of course, the only problem here is that the instruments we're looking at are short dated, are short term. But I think more work in this area is perhaps we're going to get a lot of bang up for the buck, because if the trends continue to get worse, we want to know whether pricing is being accurately incorporated into some of these financial instruments, and we don't have those non-linearities at some point where you have jumps in or drastic changes in asset prices.
And I would just add to that, thinking again about housing markets, that I think both the challenges and some of the exciting, helpful developments are similar for gradual changes as for disasters. So if we think of temperature, just average temperature and temperature distributions, I was really struck by what Sol was saying about how, states in the future are going to be, Maine is going to be more like, I think it was Arizona. But the Climate Impacts Lab has maps available at the county level predicting future temperature distributions on its website that, maybe there's potential to incorporate that information with Realtor.com as well, to give information also about gradual risks as home buyers make decisions, not just about where to live, but also how much to value or conditioning, whether to invest in that kind of adaptation at this point. I think some of those opportunities might be similar.
Great. Another important issue for financial markets is beliefs, typically beliefs of investors. And I think if anyone could talk more about the heterogeneity of those beliefs, but also the possibility for, in financial markets and in financial supervision, we're often worried about mispricing and abrupt repricing of financial assets. That is, will these, can investor beliefs shift rapidly, so that I think the importance of that would be useful to discuss. Lynn, why don't you start, since you've worked more on beliefs?
Well, I think the extent to which belief heterogeneity can be arbitraged away in technical terms depends very much on the type of asset that we're talking about, right? So with housing, because an individual house can't be shorted, it's the buyer who prices the asset. And so if the buyer's beliefs are excessively optimistic, that price will not reflect the risks properly. Whereas other types of assets, financial assets, there's more opportunity for those with access to better information to arbitrage away and make sure that prices better reflect available information at the aggregate about potential future risk. And then with regards to the sudden nature of changes in beliefs, I think that's come up in studies that a number of people have described today, where after information shocks, such as the IPCC report or the Stern report, we see large and substantial sudden movements in asset prices. And that, I think, is going to be the more of a concern potentially going forward, a risk that we should be concerned about.
Maybe, go ahead, Ricardo, you go first. I was just going to add on that I think there's some also questions about how you incorporate new information over time. And in a lot of markets, participants can do that seamlessly, but where we're reliant on government and other institutional processes, that can raise challenges. So what I'm thinking about in particular, for example, is that, for a long time, flood risk communication has relied on FEMA flood maps, but the process to update those is very lengthy and takes a really long time and might not be done for many years. And so flood risk, we know in many places, is just growing. And yet if we're kind of keeping our information products static, then that's going to be problematic for the market. And so that's why, some of these things, like we've been talking about the tool on Realtor and other places that can more dynamically sort of adapt more quickly, incorporate more information, I think are important. Another thing, is that you often see readjustments in beliefs after big disaster events. And I think that's sometimes because they are indeed learning events for people. But I also think that it's hard to visualize and really internalize risk in an abstract way, right? So it takes the realization of an event to sometimes fully incorporate that the risk has changed, if that makes sense.
Yeah, so I just want to add to that, and that's one of the aspects we wanted to analyze here. First, whether the beliefs of different investors are different about this disaster. So that's why we looked at loan pricing, not only at origination, which is when the banks actually think about the credit risk associated with this particular loan, but also in the secondary market, when this loan goes outside of the bank's balance sheet and it's sold to other investors that may have different beliefs. So that's also an area where we can see some differences. So different investors have different beliefs about the same type of loan. Related to also the concept of saliency, I think that's very important because some of these institutions may react to particular events or may react to these events in different ways depending on the information that's out there in the public domain. But the question is whether they also adapt their own risk management practices accordingly, or do they just do it temporarily because they're aware of this risk, but they don't tweak their models fully or permanently, which would have a larger impact on the way they assess this risk. And I think that's also an area where we need more work on to see whether this is fully temporary or just a more permanent shift based on the new information that they're acquiring from this either natural disasters or from the different reports that look at the trends in climate change.
I've got a question here this goes for policymakers who have a mandate around both mitigation and adaptation to climate change. How should officials strike a balance between the two? Or is that a dichotomy that we've gone past? So mitigation and adaptation, any thoughts on how to weigh those two?
I might start. I think, you know, the climate change train has left the station. So I don't think there's a trade-off in everything because resources are finite, but I think the dichotomy is somewhat outdated because both are necessary. If you look at projections with flood risk, even with a stringent global mitigation scenario, global mean sea level rise projections by 2100 are 1.5 feet is the central prediction. And to think about what that means, even under a global mitigation scenario by 2050, the risk of a 100-year flood in Boston is projected to increase 30-fold by some estimates. Now, in a high emission scenario, that's 50 times higher risk of what used to be a 100-year flood. But even with mitigation, we're going to have to adapt because there are going to be large physical changes that are coming. So I would, my 2 cents would be that both are necessary, and much in the same way as we have to deal with national defense and education, healthcare, both have to be addressed.
I agree with what Lynn said, and I'll just add that maybe we should be looking for more opportunities to unite these goals in some of our policy making. So I work particularly on disasters, and I'm thinking about the recovery process. And as terrible as disasters are, when they damage a lot of building stock, it creates an opportunity to do things differently in our rebuilding. And unfortunately, right now, there's a lot of limitations in both the FEMA and the HUD grants in using dollars more flexibly. And so there's been a lot of conversation about making sure that we make policy changes so that when we build back, we can build back, stronger for the next storm and incorporate changing risk. But we should also be talking about how, when we're building back, we can incorporate energy efficiency or solar power and renewables, or like other things that are also addressing abatement at the same time that we're addressing better adaptation.
Yeah, I agree with that. And also I think what we have to think a little bit is how we're gonna, besides the public sector, how either the financial system or other agents are gonna finance that transition or finance those investments that need to be made to adapt to this new scenario. So I think having, for example, a robust financial system that can finance some of that adaptation, I think it's crucial, because if we get to a point where the financial system is weak because they're taking a lot of losses from a climate-related risk, I think that transition is going to be even harder.
In terms of taking losses, where are you perhaps most worried? Are you thinking financial institutions, municipal governments, of course, insurance companies? There's also Freddie and Fannie, perhaps. Are there particular areas that you're worried about? Caroline, I know you mentioned that there's been quite a bit in the press about coastal real estate and how that can pose problems. Coming back to this issue of financial exposure and who's properly accounting for this financial exposure, is there any discussion that might be relevant?
So I'll jump in unless one of my panelists wants to go first. I think, as been talked about today, there's going to be impacts across every sector. I mean, right, there's nowhere that's kind of going to be immune from climate impacts, and they're going to be costly everywhere. So I think, as was also talked about, what are the costs of adaptation and what do we need to be doing? I think one of the challenges that's going to be increasingly important is a lot of the important adaptation and resilience building measures are local measures, right? They're about building codes, they're about land use, they're changes that local governments have control over, and yet we know they're really struggling right now, especially post-COVID, with having any sorts of funding to do these types of investments. And the other challenge is that resilience projects reduce future damages, but that doesn't mean they necessarily generate cash flows for today. So there's been a lot of discussion about, green bonds and other types of financing things, but you still need revenues to pay off, any new kind of debt that you take on. And so I think that's going to be one of the biggest challenges. And beyond that, across the public and private sector, it's often the case that avoided costs are not on the balance sheet. And, so lots of times we're just not keeping track of future liabilities, whether we're talking about federal spending or local spending or a private sector. And so if you're not tracking these potential disaster costs down the line, that can make investments in adaptation or resilience or disaster risk reduction or whatever terms you want to use just look like an expenditure today because you're not seeing on your balance sheet the savings down the road. And so I think these are sort of accounting challenges that we're going to have to come to terms with too.
I think in some aspect, I mean, this incentive is driven by pricing. So if for example, in the example I gave earlier, if this company, it's becoming more expensive for them to source loans because of the way they're structured geographically, at some point it's going to pay off to make those changes. I mean, who's going to finance that? I think that's a question that we have to explore. But at some point, the costs are going to be of being a structure in a way that's not resilient to this type of weather events or natural disasters. Those costs are going to be so high that they'll have to change. Of course, there are additional costs in that adaptation. So the question is whether the market is going to be able to finance that transition or not. I think that's an issue for discussion.
To what my colleagues on the panel were saying, I think we need to think not about just where are the dollar losses going to be the biggest, but also weigh things by the capacity or lack thereof with different entities and levels to respond. And so, for example, the work on municipal bonds that Ricardo referred to in his presentation has found that areas that in general already have lower rated municipal bonds are the most vulnerable to seeing further increases in bond issuance costs due to future climate risks. So that some of the lower income and lower fiscal capacity areas are differentially at risk of not being able to respond further to climate changes in the future. So I think remembering not just the magnitude, but also some areas have different capacity to respond is also where we should be putting our concern.
Another question that came up from this morning, one issue that we see for large financial institutions is that because these risks of extreme events, wildfire, heat, flood, typically manifest on a discrete geolocated basis, the impact of individual risks can be easily absorbed by large institutions through portfolio diversification. How might the co-occurrence or the correlation of these risks interact to become more material risk for large diversified firms? Again, it reminds me of the subprime trigger for the global financial crisis, where individually, of course, it was a very localized market. Suddenly, on a correlated basis, became quite material and a big vulnerability. Any thoughts on that?
I think this is an area where I think a lot of different entities are doing some work to assess what are the correlations, for example, of these extreme events, how those correlations may change and how those may generate systemic risk. So maybe some of these institutions will have to think about these correlations and these systemic events when they incorporate those into the risk management models, and think about this from a stress testing perspective. If in a particular scenario, you're gonna observe that the correlation between the assets in your portfolio like jumps because it's a globalized event. I mean, how is that gonna affect my risk? And I think that's the work that several institutions are working on right now, how to think about those correlated risk and how to incorporate them in risk management practices. And there's still more work to be done. I think we're analyzing this first from the micro level, but then you do have to aggregate this all the way to the like general equilibrium level and look at this from a holistic perspective and see how individual risks may be correlated in some way, and that could affect the systemic importance of particular events.
Yeah, I think that's right. I mean, what's the saying? In a disaster, everything is correlated, right? And I think there's several lines of evidence now that really extreme events do have the potential to kind of create dependency in the tails. And so, thinking about insurance, after events like Katrina, after 9/11, these sort of really severe impact events, lines of insurance that typically tend to be independent from each other were all hit simultaneously, right? So Katrina is a great example of that. It wasn't just property insurance, it was all these marine insurance and health insurance and life insurance, right? And auto insurance and all these other types of lines of business that tend not to, in good times, be correlated. And so, yeah, I think stress testing about these types of impacts is really important. And getting a better handle, which, as Ricardo said, I think is where a lot of the kind of research is right now, on what the type of what are the thresholds that lead to sort of a nonlinear jump in losses, and what are the dominoes that line up for that cascade of impacts to take it to a systemic level. And if you can start to identify some of those patterns, and I think I'm remembering there was a really interesting, I think R-M-S had a good report on this after Katrina about identifying some of these thresholds, like when there's a forced evacuation, that often jumps losses up to a higher level. When you lose lifelines for a long period of time, that can cascade into other types of losses. But if you can identify where those types of shifts are, can we think about adaptation measures to come in and act as circuit breakers to prevent that cascading effect, right? So that we can keep events more localized instead of becoming systemic. And in theory, that sounds really nice, but I have trouble coming up with like specifics. The only one I've heard is, hardening like pipes and stuff so that after an earthquake, I know we're talking about climate change, but after an earthquake, you don't break the water lines and then not be able to put out fires, or break the gas lines that start the fires, right? So those types of policy interventions.
Thinking about earthquakes, of course, that's a very difficult market for insurance as well. And that's one where the risks are unchanged. The underlying physical risks are unchanging. Maybe our understanding grows, but unlike in climate, where things are growing, risks are increasing, and so history is not necessarily a good perfect model for the future. I've got some questions about beliefs for Lint from the audience. Do you think people's perception of risk is also informed by their adaptation capabilities? You might have touched on this. Is it possible that the people living in high risk prone areas also have learned over time to live with risk and therefore do not see it as risk? You also talked about the overall impacts of having some percentage of the population misinformed about climate risks. Are we further worried that information asymmetries in climate risks could lead to winners and losers in the housing market, and what effect that could have on exacerbating inequality? And are there types of policy measures that could address this? These are specifically for Lint, but of course, any of you can chime in. This is a broader point. I think the point about inequality and heterogeneity in beliefs is an important one in this issue.
Yeah, those are excellent questions. I sort of addressing, so the question of could it just be that people are less concerned because they've adapted their homes? And we also ask people about adaptation, have they elevated their utilities, adaptation measures they've taken? And we again find that those who are concerned also have generally taken pure adaptive measures, right? Because the causality goes both ways. If you're more concerned, you're more willing also, or you're also more likely to take adaptive measures and preventative measures. And we find that those who are less concerned also have taken pure measures. But that's, that's a subset. There's tremendous heterogeneity, I think, is the main point. There's also very informed people who make a very informed decision to live in a risky area and have adjusted as best they can. So it's really heterogeneous. And then getting at the inequality piece, Laura Bakkenson have some work looking at, what kinds of groups are more willing or end up in the housing market suffering a bigger brunt of flood risk. And they find that it's disproportionately low income groups and vulnerable groups. So yes, I think absolutely this information asymmetry could exacerbate inequalities.
So I'm going to add something else to the conversation at the risk of misspeaking, because I'm now going to speak about something I know almost nothing about. But I've been growing increasingly concerned that I think an important part of these conversations like we're having today needs to start addressing the problems of disinformation and misinformation and polarization in our society. And I say that because I saw, I think this was a Pew report, so apologies to Pew if this was not Pew and I'm misremembering, but it was a report that polled people and found that there is no news source that a majority of Americans agree is unbiased. And if there's nowhere that we as a society can collectively take as facts and trust science to inform our decision making, I think we're going to have so much trouble in both abating our emissions and adapting to climate change from a societal perspective. And it's not an area I study, but I think it needs to be a part of these conversations. So I'm just going to raise it.
That is an important problem, and I think one that in the U.S. is sort of uniquely, maybe not uniquely, but certainly worse than in some other areas. But it is an old problem, and misinformation and people often compartmentalizing the sources of their information, and hopefully science can break through on that.
I may add one more thought to this on the issue of inequality also. Peter Christensen and co-authors have a study looking at how housing discrimination affects the ability of minority groups to avoid exposure to air pollution. And that's different than flood risk. But they find that housing discrimination is a significant contributor, making it difficult for certain groups to avoid exposure to these environmental hazards. So in terms of pollution, to the extent that we have tools to reduce housing discrimination, that's something that could also be in this context.
I have a question from the audience for Ricardo. How do you think having a multi-hazard risk insurance could help inform the loan decision-making process? Would having that, for instance, make firms A and B equal to C? And I guess there's a broader question of the spatial expanse of these risks, often not limited to a few households or firms, but more regional. And this gets back to this issue of the correlation of risks. Often we think about the correlation of risks across, there's so many ways in which they could be correlated, so many dimensions. That is, we've often thought about the physical geography, correlation across geography, but there's perhaps a correlation in industry group and sector. Very often it's not just your productive resources of a company, but also you've got to worry about your buyers and how they're being affected by these trends, adverse trends and extreme climate events. Thoughts on that, Ricardo?
Yeah, I think that's a very valid point. As we were talking at the beginning, the question is, right now, we can differentiate this type of firms and infer something out of them. But if we have like a bigger events or events that are highly correlated, probably the pricing is going to be much different than what we're observing right now. Same thing applies. So we try to do, for example, with these firms, we try to do something with the value chains, whether these effects on particular firms percolate through the value chains, which would make the event even more correlated, right? Because if you affect one firm and that firm is in turn connected to other firms, then this particular event could have more wider repercussions. So I think that's something that the issue about correlation and whether we can indeed differentiate or whether the impact of these events are going to be contained to parts of the economy, or in this case, part of particular segments of the business sector. I think it's something that we have to explore further. I mean, that's why perhaps thinking about stress testing and modeling and trying to assess whether we change those parameters and see whether this has other effects. Maybe the pricing, for example, of some of those products is different relative to what we observe right now. So I think that type of experimentation, I think, would be useful to assess whether in counterfactual environments with different parameters, we would observe something that's much different than what we're seeing right now.
Let me return to insurance markets. Are insurers getting specific enough with their pricing so that if you're a homeowner in one of those at-risk areas and you do the right thing, vegetation management in a wildfire-prone zone, or hardening windows and roofs against hurricane-force winds, you get a reduction in your insurance costs? Thinking in particular about insurance costs for coastal homeowners, or homeowners in wildfire impacted regions, they've seen their insurance premiums skyrocket. And of course, it's hard to blame insurance companies for being ahead of the curve or trying to catch up, maybe not ahead of the curve, but trying to catch up on climate projections. You know, how do we see the insurance company regulations and policy play out going forward? I mean, we talked about stress tests potentially for financial institutions, but it seems like regulators, insurance regulators as well, may have to invest more in stress testing to understand vulnerabilities.
I'll jump in. So there's a lot there, and we actually need to kind of differentiate several things like the private market from some of these public sector programs where pricing is really different. Like, so for the flood insurance program, historically, pricing has been based on broad flood zones, and they do reward some mitigation, like elevating your home, but not other types of mitigation as much. So there's certainly room to be better there. The NFIP, though, as I mentioned in my earlier remarks, is moving to an entirely new system of pricing in 2021 called Risk Rating 2.0 that's going to really modernize rating and make the prices specific to a property level and account for all sources of flood risk, riverine, coastal, surge, rainfall related flooding. And it should make communication of sort of linking the price to your risk easier. It'll eliminate those weird price cliffs that used to exist in the program, right now, where you cross from one zone. And so you and your neighbor, assuming your homes are built the same and the elevation is not an actual cliff, you should be paying similar rates, but actually you could see, you know, hundreds and hundreds of dollars of difference in your rates when you cross those zones. It's also going to undo a perverse cross subsidy in the NFIP right now, where high value homes are paying too little and low valued homes are paying too much. So to the extent you think that high income people are in high valued homes and vice versa, that's pretty regressive. So that's all going to be, you know, important to changing pricing. Gulf Coast states and East Coast states prone to hurricanes all mandate that insurers offer discounts for mitigation measures, but I'll say there's little empirical evidence that those price discounts actually incentivize new mitigation as opposed to rewarding mitigation that's just done anyway. And you know, there's a lot to talk here and I see we're kind of running out of time. I'll just add one last thing, which is that I think there's also more to think about how insurance could help with mitigation, not just ex ante with price signals, but ex post. So like the North Carolina wind pool, and also I know we're talking about climate, but I just see so many parallels and disasters that I use the earthquake insurance as a analogy an awful lot. So in the earthquake authority in California, both of those programs have found it cost effective to actually give grants to their customers to build safer afterwards, because the lowered losses reduce reinsurance costs and so forth. But those incentives don't quite work in the private sector. So there's some big differences. Sorry, I could go on and on, but I'll stop talking.
Great. We should probably stop there. Thanks to all three of you for this panel. This very interesting. Hannah, are you taking over now?
Yeah, we're about to head into a short 15-minute break, and then we'll return with two members of Congress.
All right, everybody, welcome back from the break. We are honored to have two distinguished members of Congress with us today to close out the event, starting with Senator Brian Schatz. Senator Schatz, are you with us?
I am. Can you hear me okay?
I can. Thanks so much for joining us. Let me briefly introduce the senator. Brian Schatz is Hawaii's senior senator. He serves on the Appropriations Committee, the Commerce, Science, and Transportation Committee, the Banking, Housing, and Urban Affairs Committee, the Indian Affairs Committee, and the Select Committee on Ethics. Importantly, Senator Schatz also chairs the Special Committee on the Climate Crisis and serves as the Senate Democratic Caucus's leadership team as Chief Deputy Whip. Senator Schatz has also been a leading voice in the Senate on climate-related risk in the financial system as the sponsor of the 2019 Climate Change Financial Risk Act. Senator Schatz, it's a pleasure to have you here with us. We've spent the day so far hearing from academics, researching the economic risks of climate change and financial regulators that need that research in the work that they do. Would love to have you open up with any opening remarks that you have before we go to a discussion and Q&A from the audience.
Sure. First of all, thank you for the great work that everybody's doing. And I'll just offer a couple of initial thoughts. First of all, risk is risk. And I certainly have my own view about policy prescriptions as it relates to the climate crisis and the opportunities related to climate action for economic development across the country. But that's not what we're talking about when we talk about all of the 3- and 4-letter agencies that oversee the financial sector. What we are talking about is the fact that all of these agencies, the SEC, the Fed, the OCC, the CFTC, and the FDIC, among others, have an obligation under current statutory law to make sure that risk is quantified on behalf of investors and others. And climate risk, because it has been a subject of political polarization and because it's difficult to quantify, has been booked at zero. Yes, this stuff is hard. Yes, we need common reporting platforms. Yes, we need to work through all of the technical aspects and try to get the numbers, or at least the ranges of numbers, right. But the alternative, which we have been living in, is to book the risk at zero. And at this point, that is absolutely untenable, which is why we've seen some pretty encouraging progress in most of the federal regulators. And I think we're about to see more in the next administration. So we've been able to work on a bipartisan basis simply because investors need to know what they're getting into, and risk is risk.
That's terrific. So maybe building off of that, can you talk a little bit about what of the areas of risk management that you think the Fed and the OCC and the SEC and the CFTC need to do, they already have the statutory authority for, and what needs new legislation, like the legislation that you introduced last year? Can you hear us, Senator? We can't hear you. We lost your audio for a moment. Unfortunately, we're still unable to hear you. All right, well, hopefully the senator will dial back in a moment.
I'm back. Can you hear me?
Yeah, we can. Thank you very much. We can hear you great.
Okay. I didn't get the second part of your question.
Yeah, so the question was, what of the range of areas where you think that the Fed and the OCC and CFTC and the SEC need to step up the pricing from zero, where do they have the authority under existing law to do so, and where do you think there needs to be new legislation like the legislation that you introduced?
Well, I mean, I'm a little torn about my own legislation in the following way. I think it would be great if we could enact a law that required climate stress tests. But I had an argument actually with my staff about this, because sometimes when you introduce legislation in this space, you're almost stipulating to the idea that without legislation, what you're suggesting can't happen. And that's just not the case. All of these agencies don't just have the authority, but actually the obligation under law to measure risk. The SEC should mandate public companies climate risk disclosure. The Fed, the OCC, and the FDIC just have to incorporate this into their daily supervisory work. And the Fed needs to look at climate risk in terms of their financial stability surveillance. And so the point is that they don't need new statutory authorization. In fact, if they don't measure risk, now that climate risk is not a future risk, but a current fiscal and calendar year risk, they're violating the law by allowing public companies and others to not quantify and disclose the range of possibilities. I'll also just say that some of these agencies are worse than others. We sent a letter to the FDIC about what they were doing in the space of climate risk, and they wrote back to us basically about the possibility that bank branches get flooded. And that is how much some agencies continue to miss the point about the systemic risk posed by climate change, and think of it in very, very narrow terms. Others, like the Fed, are in the process of joining the Network for the Greening of the Financial System. The CFTC, on a bipartisan, unanimous basis, is doing some pretty incredible work. And so what is important to me is that even despite all of my disagreements with the Trump administration, these agencies truly are independent and have moved forward in this space despite the Trump administration's general view about climate action.
Terrific. I'm going to ask the Senator a couple more questions, and if you have questions for the Senator, go ahead and put them in the chat. So you mentioned the NGFS. Is there we're a little bit late to the table on the central bank side. Is there any benefit in being late? Are there things that we can learn from the work that the NGFS members have done to date on the stress testing side in particular?
Yes, I think we can learn from a lot of the work that has been done. No, I don't want to spin it like it's great that we were late to the party. I think the United States must go back to, as Madeleine Albright called us, the indispensable nation, and especially as it relates to climate. The rest of the world continues to look to us, not just our political leadership, but our financial markets in terms of what's going to happen in terms of climate change and climate action. So. But it is true that this stuff is hard. It is true that a lot of the companies that actually want to be in the business of disclosing risk don't have a common platform for reporting it. So they're doing this kind of like configuration of stuff on their own, and are actually going to the regulators and saying, please give us something that all of our competitors can be accountable to, and please give us something that we don't have to configure ourselves, and that to the extent that some of these publicly traded companies exist internationally, so that they can do one climate disclosure that sort of applies across the board. The Bank of England and NGFS has done some really incredible work, but some of the conversations I've had with the real experts in this space are cautioning that it's not as simple as just bludgeoning the regulators into requiring the risk disclosure. This really has to be done right. Now, we don't have 5 years to get it right. We don't have 10 years to get it right, but still, this stuff is highly technical, has massive economic implications, and we do need to make sure that the regulators feel comfortable that they're not doing something off the seat of their pants, or they'll stop, because that's the one thing that especially professional staff will essentially boycott, is anything that seems unserious or unsupportable by the facts.
Terrific, thank you. So one government acronym we haven't mentioned yet is FHFA, the Federal Housing Finance Authority, which oversees the GSEs, Freddie Mac and Fannie Mae. In the panel right before you joined, there was a lot of discussion about reform of the National Flood Insurance Program and how we address the disproportionate impacts of flooding on the affordability of home ownership for low-income families and communities of color. Can you talk a little bit about what are some of the policy approaches that can both make communities more resilient to the impacts of flooding, can safeguard the mortgage market from systemic risk, but can also address disparities in the impact of flooding and in flood insurance reform?
Can you hear me okay?
Yep, we can hear you great.
Okay. This one is hard, and I don't think we should evade the political and policy difficulty here, because if you're looking at this purely from the standpoint of accurately reflecting climate-related physical risk in the housing market, you would go down a certain policy path. But as I've done my work as the chair of the Special Committee on the Climate Crisis in the Senate, there's been I think a legitimate sense among communities of color, people in low-income communities, that those who are working on the climate problem in the past have been mostly coastal and have been mostly in New York City on Wall Street and in Washington, D.C. on K Street. Good people working on this problem, but ignoring the actual economic impacts of the transformation that is going to occur, either the transformation to a clean energy economy or the catastrophic transformation that's going to happen if we don't take action on climate. This stuff is hard, and if we have accurate flood maps and better data, that will help. But there is an inherent tension in terms of communities that live in the coastal zone who are not wealthy and who may end up with unaffordable mortgage rates or insurance rates if we accurately price in climate risk sort of instantaneously. And so I'm still wrestling through this and don't want to pretend to have a solution. What has happened in Congress is every time the possibility of homeowners getting hit with the actual cost of being in a flood zone, there's a political revolt, because you've got homeowners who call their member of Congress and say, please repeal Biggert Waters, right? And so we've got to sort of measure twice and cut once and understand that this particular question has human implications as we accurately price the risk. And to the degree and extent that climate action and even climate inaction is going to disproportionately impact people who have already been screwed by this economy, we have to be very, very careful in this space.
Are there particular areas where, as the federal government looks to rebuilding from a deep recession caused by the COVID pandemic, where you see areas that are particularly promising for improving resilience and addressing climate-related risks alongside the rebuilding of the economy that needs to occur over the next couple of years? Oh, Senator, we lost you again for...
How about now?
Perfect. Excellent. We found the fix.
Well, I just have to press mute and then unmute. I don't know.
Excellent.
So as we do infrastructure, whether it's in FEMA subsidies for rebuilding, whether it's in the transportation reauthorization, or even on the defense side, everything has to be done with an eye towards climate. And not just because I have a specific objective of achieving climate action, but because it's the smart way to do things. I also think that FEMA should not just be authorized, but required. If a Republican friend of mine said, I don't mind bringing in FEMA money to rebuild your town, but I don't want to do it 3 times. And I think that if certain areas are vulnerable to natural disaster over and over and over again, then FEMA has to rethink whether or not they want to rebuild the same infrastructure. And that's a question of federal statute. In the same place, also a question of federal statute. So we're going to have to move forward with what they call managed retreat over time. But we do live in a democracy, and in a free market where these people have certain private property rights themselves, but they don't have a right to a federal subsidy to rebuild in the same place. And that's, I think, where the leverage lies.
Great. So I'm going to turn to audience questions now. Go ahead and put them in the chat if you have them. The first question is, what mechanisms can the federal government quickly identify, collect, and endorse the best data, maps, models of climate risk to allow industry and agencies to perform the required assessments and disclosures? Something that can move at the speed with which you indicate that the regulators need to move.
You know, I would defer those questions to some of your experts, probably in the audience. My job is to make sure that these agencies, as they come before as the nominees come before the Banking Committee and the Commerce Committee and the Appropriations Committee, understand that their obligation is to mandate the quantification of this risk and to incorporate it into their daily work, their daily supervision. But I'm not sure that I have the expertise to answer that question on a technical level. I know politicians don't usually say they lack the expertise, but I'm trying something new.
Excellent. Another question from an audience member. It's clear that the political parties have different viewpoints on the issue of climate change. What are areas where there's possibility for bipartisan progress?
It's a good question. Wind and solar is increasingly popular across the board because especially wind is really everywhere, and at least the growth in wind energy is tending towards red states right now. Energy storage. Look, I don't want to have too partisan of a conversation, but if you talk to individual members on the Republican side, a lot of them are amenable to conservation and efficiency, wind and solar, energy storage, ARPA-E, even infrastructure work in the energy space, smart grid, and other stuff. It tends to be Mitch McConnell who stops things from moving forward because he has the sole authority to determine, what gets considered on the Senate floor. And I apologize for inserting that partisan or seemingly partisan statement, but it is just a statement of fact that a lot of these bills would succeed if they ever saw floor time. And unfortunately, Leader McConnell, I think, is probably 5 to 10 years behind his conference on the issue of climate change.
Got it. As you think about the nominations that are going to be coming before the committees that you sit on, where are you going to be paying the most attention to how nominees are thinking about climate risk, particularly as it relates to the financial system?
Oh, it's all of these. It's the SEC, it's the Fed, it's the OCC, it's the FDIC. Those are in the Banking Committee space. But I'm also looking at the Department of Defense. Michelle Flournoy is very interesting. She's qualified to be the SecDef anyway, but she has a particular interest in climate as a national security issue and has recognized that. Certainly, under Democratic administrations, our secretaries of state have internalized the need for climate action. And then the obvious ones, Energy Secretary, Interior Secretary. I'm particularly pleased about Brian Deese. Brian and I worked together on the establishment of the Marine Monument in Hawaii, the Papahanaumokuakea Monument, 500,000 square miles of Marine Monument. And I think he's a person who is deeply passionate on these issues and understands from his professional experience the nexus between economic challenges and climate action.
Great. So in the audience, we have a mix of people from academic backgrounds, from financial services. I think a question that a lot of the academic researchers, particularly some of the younger academic researchers going into this field, have is, how do they make the work that they're doing have impact for policymakers? If you're a young climate scientist or an economist that is passionate about addressing climate change and doing research, how do you connect that to the policy process? Do you have any general guidance for the young researchers on the call?
Oh gosh, that's a really good question. I wish I had like a pat answer for it because I have 3 brothers. My older brother is a professor of political science at the University of Toronto, and he sort of asked me this question, and I don't have a good one. I don't have a good answer other than through think tanks and all the rest of it. I will say that a lot of offices in the Congress, even during COVID, have fellowships, and many of the people who have informed my best policymaking have been fellows in my office. Some of them end up going back to academia, but some of them end up, working on the Hill or working in an administration or in the nonprofit sector. So, if you really want to influence policymaker, you got to be in a policymaker's office. Otherwise, you have to sort of wend your way through both the academic world into the think tank world, and it gets so intermediated that unless your idea is totally dynamite or you are especially skilled at working your connections, that's a long road. And so my better recommendation is try to figure out how you can work on the Hill, even if it's just for a 6 or 12-week stint.
Do you ever have AAAS fellows in your office? That seems like a pretty successful model for how to get young researchers some exposure and experience in policymaking.
I do. I think almost every year, and we have NOAA fellows, and we've had fellows from. We take great pride in integrating our fellows into our staff and putting them to work. I mean, I used to actually run a nonprofit that got kids involved in volunteer work, and there was always this kind of tension between getting the kid a T-shirt and a sort of bento box lunch and a thank you note, and I always forgoed all of that and said the way to thank a volunteer is to make them feel like their Saturday was well spent. And I think that same thinking applies for a fellowship, which is to say, fellowships are useful for the fellow if they're useful to the member. If all you're doing is something in the kind of academic space in a cubicle in a federal office, that's not much. So we just put you on the team, and you may be doing stuff in your space. We certainly want your expertise, but you may end up, working in telecom for a half a week, because we believe that once you're in our office, you're part of Team Schatz. So we really enjoy the perspective that we get from academia. But more importantly, we integrate it into our actual work.
That's great. All right, Senator, last audience question for you, and then we'll let you go. A member asks, are there inspiring examples of green recovery emerging from around the world or in the European Union, for example? And should the US consider incorporating climate into COVID recovery measures?
Let me, I don't know that I can off the top of my head give you an inspiring example of climate being integrated into COVID recovery, but I think that's what Build Back Better means. And I'm not one that's accustomed to using, campaign slogans in the policymaking context. In fact, I've eschewed slogans for my own campaigns because they just make me feel uncomfortable. But I think Build Back Better is a really smart way to look at it. It goes to FEMA and how we do our subsidies. It goes back to how we're going to redo an energy grid. It goes back to our transportation systems. It goes back to how we're going to improve our agricultural and forestry processes to be better at becoming carbon sinks. And so, yeah, I think that I don't want to say I'm totally surprised, but I've been thrilled at the extent to which every single nominee who's got any nexus with climate in the Biden transition seems to understand that, just like I deal with my office, I say, if you work transportation, you're a climate LA. If you're on the climate side, you're a climate. If you do ag, you're a climate person. There is no person in my office who doesn't have responsibility over climate. And I think that's how we need to look at infrastructure spending and COVID recovery, because COVID is the crisis, the public health crisis of 2020 and 2021. But the crisis of our generation is climate change. And as we recover from COVID, we're going to have to address this problem together.
Well, that sounds like a great place to stop. Senator Schatz, thank you so much for joining us today, for the generosity with your time. One of the downsides of doing this by Zoom is we cannot applaud you on your way out, but it was great to have you here with us today and to share your thoughts on this critical topic. Have a wonderful weekend.
Thanks very much. Thanks, everybody.
Excellent. And next, we're honored to be joined by Representative Patrick McHenry. Representative McHenry comes from the 10th Congressional District in North Carolina, serving his 8th term to the United States Congress. His district stretches from the suburbs of Charlotte to Asheville in the Blue Ridge Mountains. Congressman McHenry serves as the Republican leader of the House Financial Services Committee, a committee he has served on since he was elected to Congress in 2004. Relevant to our conversation today, this committee provides oversight of the Federal Reserve, the Treasury Department, the Securities and Exchange Commission, and other federal financial regulators. Yesterday, Representative McHenry was reelected as the Financial Services Committee's ranking member for the 117th Congress. Congratulations on that, Representative McHenry. Thank you so much for joining us today. You're coming at the end of a rich day of discussion between academics who are researching the economic and financial risks of climate change and regulators thinking about these questions. And I guess to start, maybe you could tell us a little bit about how you think about climate risk in your home district of North Carolina. Bring it home and make it a little personal for us.
Well, sure. Thank you. First of all, thanks for the invitation. And I know I'm sort of late in the day, and I know it's difficult, especially in a normal time, and even more difficult via Zoom. But it's an honor to be with you, and really glad to be a part of this event. I think we can still call them events, right? So the way I think about it is you have to talk to people where they are as they are. And so my district in North Carolina is broadly sort of the western part. It's small towns, it's suburbia. And it is a ruby red district in a highly divided partisan atmosphere, so quite Republican. And so generically you think, well, why is this Republican guy from a Republican district talking about climate? And it's because it's real. It affects people's lives. It is an unseen risk until you're able to explain what they're seeing. And what I mean by that is what we see here in North Carolina is more frequent hurricane events. We see more frequent severe flooding events. We see via the TV more frequent wildfire events in California. And so we're able to see that there are significant climate events that are impacting people's lives, impacting people's economic welfare, and impacting our economic life generally. And so, that's what I'm able to talk about to my constituents, and also the fact that, frankly, my district, the beauty of the district, of the area, is a great selling point for visiting, and a great selling point for why people have chosen Western North Carolina to retire as a destination spot for retirement. So, that I try to bring it home to where people are as they are, and that's been I think that's been successful.
How do you think about, from your perch on the House Financial Services Committee, how do you think about the nature of climate risk to the financial sector in the U.S. and to financial stability around the world?
Well, okay. On its surface, it has absolutely nothing to do with financial risk. Okay, shocking that I'm saying that, but let me tell you, the idea that somebody gets sick a half a world away or a full on the other side of the planet also isn't a risk, right? Until it is. And so I think of climate risk as it impacts the bottom line to government expenditures. So I can give you a couple of examples. One example I would give you is the National Flood Insurance Program, NFIP. Up until 2005, the NFIP had experienced, Hurricane Katrina in 2005. Before that, the flood insurance program, our National Flood Insurance Program, had experienced $2 billion events, in its 40 years. Since then, we've experienced 6. And so you're seeing that as more severe economic losses just to that program. Then you think about this large portfolio of Fannie Mae and Freddie Mac of where those houses are located. And yet we don't have the proper markings with the mapping, nor do we have a proper understanding of the flooding impacts on those two portfolios, the largest two financial portfolios in the world. And so I think about the government sphere first, the taxpayer risk first. And I want to explain, and I want to understand how we mitigate that risk, because we actually have really not an election by election or quarter by quarter revenue stream that we have to match up. But we're talking about what this country is going to be like for my children and my grandchildren, and the type of planning and foresight we need to have for them to have a rich economic opportunity. So I'm looking at those two examples, the National Flood Insurance Program and Fannie Mae and Freddie Mac, is really the starting point for understanding the nature of the economic risk. Moreover, when the Federal Reserve says that we have to incorporate climate risk into our risk assessment, I applaud them for that. Jay Powell, Chairman Powell, has been at the knife's edge, if that's the right term, but he's been on the leading edge of preparedness going into COVID. So the decisions he made in January and February mitigated the downside risks of March and April and May, and also what we're experiencing now. So likewise, we need to make sure that we understand the nature of this risk. And then once we have some the broad-based proper understanding of climate risk, then we need to have those mitigation measures in order to match it up. And so that, I think, is really the starting edge, is first the measurement of the risk, and we're still in that phase. And sadly, we're still in that phase, but we need to make sure we get that right so that we can get into the deeper conversation on mitigation measures.
Can we go back to NFIP for a minute? So you have bipartisan legislation to reform NFIP. Can you talk a little bit about what that legislation would do, and then maybe speak to how much FEMA's planned risk rating 2.0 would address that, and what would still need to be addressed?
Well, the truth is the risk rating 2.0 was held up by some of my colleagues that were fearful that their constituents' flood insurance rates would go up. So they held up that legislation that that Chairwoman Waters, Maxine Waters, and I negotiated, and we had wide bipartisan support in committee, but across the House floor, and some in the Senate blocked that measure. The effect of the reforms that we negotiated would mean that we have a better measurement of risk, and we have a better understanding of the markings of those properties that have had repetitive losses of enormous size, and those are really the front lines of need for change, right? So if you keep building back the house 3, 4, 5 times after a total loss event, I think we need to assess that. I think we need to understand how many properties there are that are in that have been repetitive full losses multiple times. Let's start there. We haven't even started there. That's just one of the reforms that we have in our bill. And so what we're trying to do is get a proper risk assessment of the taxpayer risk and exposure. If you see from 2000, I'm sorry, let me rewind. So from 1985 to 1994, you had the NFIP operate with zero debt. But in 24 of the last 26 fiscal years, the program is into the fiscal year owing the taxpayer money. So that's one of the steps that we have to take to have a better understanding. And then 2 additional points. We need better mapping and a better assessment of mapping. The government should have the best mapping of flood risk. We do not. The private sector has that. We need to update our mapping. That's 1. And then 2, I think it's reasonable for us to take into account more adverse weather events and the nature of those more adverse weather events, and make sure that the NFIP is entitled to use that in their calculation for year-over-year risk to the taxpayer. You could call it assessment of climate risk. You could call it the assessment of the weather coming for the next year, right? And if we could do that with an almanac for farmers, why in the hell can't we do that for the taxpayer? So let's have some better assessment with that program as well.
So on that point, the CBO is, I'm sure you know, in September for the first time included the estimates of the cost of climate change in their long-term budget outlook. Outside of NFIP, are there other areas of climate risk that you think have the potential to have significant or are currently having significant budgetary implications that the federal government should be paying closer attention to?
Well, I mean, I mentioned the GSEs, Fannie Mae and Freddie Mac. The First Street Foundation reported 16 million homes are located in areas that are facing an annual flood risk of 1% or higher. And that's roughly roughly double what the NFIP's current data says. So if you have some of the best data inputs from the private sector through the First Street Foundation, showing that our risk is actually double the number of properties, that tells me that we've got to change. We got to up our data game for the government. And rather than trying to reinvent the wheel, we need to incorporate that private sector data for Fannie Mae and Freddie Mac. That is really front and center in my mind. I also see some concern here. So with NFIP, there's a real move among elected officials to deny through honest assessment of rates that the climate is changing and we have more severe weather events. You also see this in California among elected officials that are telling insurers that you cannot have an honest assessment of wildfire risk due to severe wildfires that they've had. That is denying the existence of climate change. That is denying and being dishonest about the nature of severe weather events. And even a state like California that is more, I think, farsighted in the climate discussion in many regards, they are quite medieval in their view of climate assessment when it comes to wildfires. And I think that just tells you the challenges we're up against, both for both climate risk and assessment, and then incorporating that into really governmental risk and taxpayer risk.
Great. So one more question from me on that, and then I'll turn to audience questions. So if you have any questions for Representative McHenry, go ahead and post them into the Q&A. Obviously, one of the core political challenges to rate reform is the impact on as you mentioned, on rates for existing homeowners. And I think particularly concerned about the impact on low-income households. In the years that you've been working on this, are there good creative solutions to try to address the disproportionate impact of rate reform on lower income households in a way that makes it more viable and more equitable?
Well, first, we do have, first, NFIP, if you have an existing NFIP program, insurance policy, we're not talking about substantial major changes that would raise your rates year over year dramatically. We actually have a rate cap increase on the program. What we're talking about, though, is if you own a piece of property and you sell it to somebody else, then they would have a new policy. We're also saying that we should be able to bring in the private sector for risk mitigation and some assessment of the cost of getting some private sector actuarial data on the cost of the risk of the book of business. That gives us better insight as well into how expensive this portfolio could be, right, on an annual basis. And we also have additional programs for those that are low income participants within the NFIP program. So we've been thoughtful, and I think over the last really 50 years, I think the NFIP program is tried to be affordable, especially for those that are on the margins.
Great. All right. So turning to some of the questions from our audience. One question that our event today focused on physical climate risks, the shocks like storm damage, fires, declining agricultural yield and productivity, and changes in labor productivity. A question, I think you touched on this a little bit, but if there's anything you want to expand on about how these extreme weather events fit into into the federal government's framework for protecting financial stability.
Well, I think financial stability is little talked about, but is our first obligation, right? So you think of financial stability as, in essence, you think about it in the first obligation of the federal government is to keep our people safe, right? So you can think about it manifesting itself as preparations for external enemies trying to attack us. Well, financial stability is through another number of different means an attack on our system. So we have to be prepared for that. When I took this role as the lead Republican on the Financial Services Committee, I spent my first months doing a full assessment of each regulator's potential risks. Whether that's what you think of as the financial crisis from 10 years ago, the financial products, the illiquid financial products that then cause harm to the real economy. You think of accounting scandals like we had with WorldCom and Enron 20 years ago, 35 years ago, the S&L crisis. You think about those different risks. So in that, my assessment was looking at the GSEs and looking at NFIP, and I look at those as severe risks to the taxpayer. And the severe risk to the taxpayer is not financial malfeasance, it is willful incompetence to incorporate new information in new data. So let's acknowledge reality. And yet, in acknowledging reality, which is something I think is really very important for politicians to do, first acknowledge reality. Now, you may not like the reality, and you may want to go in a liberal direction or a conservative direction or whatever you may want to do with the information, but you have to first acknowledge the truth. And the truth is, man has had an impact on our climate. And as a result of that, we have more severe weather events, and those more severe weather events manifest itself in financial risk. Now, we need to acknowledge those things, and we need good inputs to make sure that we're able to measure those risks. I think it's very difficult for a small business to assess a climate risk, but I think it's much easier for a $1 trillion company to assess climate risk on an annual and 5-year, 10-year horizon. And so let's acknowledge some of those differences. But for our government, we should have that, and we should have good data in order to put into that machine to make sure that we're doing the right thing for the taxpayer here and now and over the long term.
Excellent, thank you. A question about climate risk disclosures for publicly traded companies from the SEC. We heard from Bob Litterman, who had chaired the CFTC MRAC committee report over the summer, and one of their recommendations was that improving the robustness of corporate disclosures of climate risk. SEC obviously falls under your jurisdiction, House Financial Services. Is that an issue that you've tracked closely? Do you have any views on corporate risk disclosure that you want to share?
Yes, look, we have the nexus here is for financial disclosure through the securities, through our securities law, is whether or not it has an economic impact on the business. So if you look at the energy sector, they have best in class. I would say that they have best in class climate disclosures because they're in that business, right? So if you have a bunch of geologists, they can actually speak to science in a different way than maybe a small health insurer would be able to have that same assessment. Maybe more than a construction company could have that assessment. So the difficulty here is when you get into a securities mandate from the SEC, is that you have an appetite from some to put this disclosure so you can compare apples to apples without acknowledging the differences within industry and segments of industry. And so I don't think a one-size-fits-all mandate of across-the-board climate disclosures works. And not that climate disclosures aren't important and necessary, but we have to have a reasonable approach to this. A small cap company to try to do that level of assessment is very different than a large cap company. And so I think we have to have the question of materiality as it impacts at the bottom line. And I think that's a hallmark of good securities regulation for public companies. But I think there is room for us to come up with something that works based off of size, based off of materiality, and based off of segment of industry. And that's far more complicated, obviously, than just a single disclosure set across every public company in the United States. And so I find this is quite attractive in discussion, in political discussion, but much more difficult to deliver what is effective for securities regulation, and at the same time, something that that businesses will be able to reasonably do on a quarterly basis to measure 10, 20, 30, 50-year risk. And so, I think there's a lot more work that has to be done to get bipartisan appetite for the type of disclosures that I think would be right and fitting.
Great. Last question for you, Representative, and then we'll let you go from the audience, which is, climate change is a long-term challenge, and elections happen frequently, particularly if you're a House member. And do you have any insight to share on how elected officials, particularly those with frequent election cycles, like those in the House of Representatives, can engage constituents around these kind of longer-term issues in a way that is aligned with your need to get reelected?
Well, I think when I talk about California wildfires, I give you that as a real live example. You have politicians saying that we need to have major action for climate change, and I agree. There are action against climate change, and I agree. But they're not willing to do the right thing to actually price insurance risk appropriately. So they use government regulation to go absolutely against the goal of climate action. It is difficult. It is very difficult to have a discussion around climate change, just like it's very difficult to have a conversation around debt and deficits for federal spending. But these things are necessary because I've been hired by my constituents to make the right decisions for them on their behalf for the long term. And that doesn't mean that they give me the job for the long term, but it's my obligation to be a leader is to look over the horizon and to see what is coming, and trying to lead people to see the same thing, and to see the necessity of taking individual steps day by day to mitigate what is a long-term harm. And climate is one that is very difficult for people to feel or sense moment by moment. But it is highly necessary for us to take concerted action to mitigate what the scientists are telling us is the likelihood in front of us. And we can absolutely change, we can change course, but it's going to take concerted action, and it's not going to be happenstance or luck that gets us through it. But concerted action across the board. And I think we can do that. And I'm trying to take my reasonable steps in every way possible within my committee of jurisdiction.
All right, well, that's a pretty good place to close. Representative Patrick McHenry, thank you so much for taking the time to join us today. Thank you for your leadership on this issue. And please imagine mentally the round of applause from our 163 participants on this Zoom call today. And we hope you'll be able to join us again in the future.
Thanks, Trevor. Take care. Have a great day.
Take care. Bye-bye. Excellent. And to close us out for the day, we've got Michael Greenstone, who is Professor of Economics and Director of the Energy Policy Institute at the University of Chicago, and is co-director with myself, Bob, and Saul of the Climate Impact Lab. Michael, over to you.
Excellent. Thank you, Trevor. And thank you for such a fascinating conversation. So let me just start by saying if Trevor and Glenn or Rhodium and the San Francisco Fed ever ask you that if you'd like to co-organize a conference with them, you should sign up right away. They did all the work, and the result was this amazing day. And I especially want to acknowledge Trevor, Hannah Hess, Shanley Augustin, Maggie Young from Rhodium, and then from the San Francisco Fed, Glenn Rudebusch, and Adam Healy. This was kind of the intellectual ground and policy ground and real world ground that was covered today was kind of amazing. Of course, we also want to thank the Energy Policy Institute here in Chicago, the Goldman School of Public Policy, the Griffin Applied Economics Incubator, and Rhodium, but with the main sponsors, of course, being the Climate Impact Lab and the Federal Reserve Bank of San Francisco. So two things stuck out to me that I wanted to just draw emphasis to in the various discussions today. So one thing that I thought was especially nice was Representative McHenry saying that it was critical that we acknowledge reality. And a second thing that stuck out in Bob Litterman's talk at lunch was his view, which I share, and I share many things, many views of Bob, but especially share it, that we need to have kind of bottoms up information on what climate change is going to do and what it's going to look like. And so with that, I want to try and see if I can share my slides. And I think this will work. Okay, and I just put together a few slides that I want to try and close out the day with that take both of those as kind of motivations or themes. And don't worry, I can do 24 slides in 7 minutes. And so in particular, what I wanted to talk about, which was a thread across the day, is that if we are going to have a bottoms up sense of what climate change is going to do, and we're going to do that in a way that acknowledges reality, I think a critical ingredient in that is, well, what do we know about what the likely damages of climate change are going to be? And I think one point that I want to make, and that I think was kind of a starting point of the Climate Impact Lab, is that the existing IAM damage functions are no longer on the scientific frontier. They absolutely were, and they were foundational, but I think this is, a very famous graph of what the damages from climate change will be with different, in 2100, with different levels of warming and measured as shared global GDP using the three main IAMs that people rely on. And, as early as 2017, but probably even earlier, there was a sense that this information was pretty dated. And, one way to illustrate that is just this little histogram of the studies that underlie the evidence in the existing IAMs. And you can see much of it was from the 1990s. And what it does is it misses this massive growth of literature. We stopped counting in 2015. We probably should have, it'd be, up here if we kept it going forward. Massive growth in understanding and new evidence. And the idea of is that there's an arbitrage opportunity. That, in fact, the National Academy of Sciences called for just that in 2017. A second way in which I think the existing IAMs are not delivering in the kind of acknowledging reality in a bottoms-up way is that they're very geographically coarse. So the original DICE model treated the whole world as one region. So Moscow was the same as Miami. The update of fund had 16 regions. That also, is a pretty coarse view of the world. But that, that was where data and computing were. And so what I just want to talk for, this is a thread that has been throughout the whole day, is a new approach, and how I think it's important that, as researchers, we all sign on to this and, load fuel into the train. I don't think we should say coal anymore, but load fuel into the train. And as policymakers take account of the new information. And so that's one thing that's one reason we started the Climate Impact Lab, which was to do just that. There are really two goals of the Climate Impact Lab. The first is to deliver an empirically founded social cost of carbon. And then the second is to provide what we like to call hyperlocal climate damage data. And that's the kind of bottoms up information that I think Bob Litterman was talking about. We set, and I think these are three very real kind of good housekeeping principles to strive for, is that we should, the damage function should be based on the best available empirical evidence. They should reflect damages from around the world, not just from a few rich countries where you happen to have data, which unfortunately was all that was available in the past. And that it should reflect, the estimate should reflect the adaptations people are going to undertake as well, and the benefits of those adaptations as well as their costs. A key first step in this is acknowledging we now have data from all over the world in ways that we didn't before. And before we had data from a couple cities in Europe. Now we have data from the whole world. So in examination mortality, there's 60% of the world's population covered. In energy, it's possible to have essentially the entire world, maybe 95% of the entire world covered. And that just opens doors and information and insights that were just simply not available before. So I guess what I'm trying to say is, coming back to the two main goals that I think this revolution in computing and access to data have made possible, is that an empirical social cost of carbon is now possible. It doesn't have to be based on assumptions. We now have data. And what is emerging is a wholly different understanding of what the impacts of climate change are going to be. So as a reference point, here's the full social cost of carbon, the monetized damages of the release of an additional ton of CO2, with the Obama administration number relying on the existing IAMs. And here's the Trump number. We don't have time to get into that. But what I just want to focus your attention on is how different. In the blue, the answer is when you use data than when you had to completely rely on assumptions. And so this is like more than an order of magnitude larger, the mortality impacts. The impacts on energy demand are completely different when you use data, as we did in the Climate Impact Lab, than was possible for the fund IAM. Fran Moore has done some important work on agriculture, where she too gets a very different answer using these newer techniques than was coming out of the IAM. So I just want to put a pin in, we're learning so much, and it's giving you a much more nuanced and different picture. Related to that is, it is now possible, instead of dividing the world into 1 or 16 regions, you can develop the kinds of bottoms up hyperlocal estimates that people talked about so much today. And indeed, in our work in Climate Impact Lab, you can do it for about 25,000 regions around the world. And let me just give you a flavor of what emerges when you have the computing power and the data that allow for that. So this is an estimate of what the impacts of on mortality risk will be from changes in temperature due to climate change at the end of the century. And you can see how different it is in, say, Oslo, where they will be enormously beneficial in terms of reducing mortality, because they'll be getting rid of all these very, very hot cold days that are dangerous, versus Accra, where it will be devastatingly bad. Because there are many more risky hot days will emerge. And you can even see within countries in the United States, there'll be lots of heterogeneity in what the total impacts are going to be. And understanding that will allow for the kind of local planning and probably, I think, much more nuanced large-scale policies as well. This heterogeneity or these differences across places are, apparent not just with mortality. Here's a total electricity consumption. You can see the change in India is going to be enormous gain in energy consumption. In the US, there'll be a rough balance between less heating to deal with cold days and increased cooling for hot days. Other fuels, you can see most of the world benefit by getting rid of very cold days. So I'll just close with, I think we're really at the dawn of a new era of understanding about what the impacts of climate change are, or what is coming. At the Climate Impact Lab, we are trying to develop wholesale estimates of what that will be. But we're just and that are trying to take advantage of that. And I think a lot of that was on display today. But I guess my main thesis that I wanted to leave everyone with is, I think it is time to embrace that what we understand about what is understood about the impacts of climate change is evolving. It's evolving very rapidly. And in order to produce the kinds of policy that will best serve the people of the planet, it's important that the policies kind of be based on this updated kind of scientific frontier information. So with that, I wanted to say thank you. It was technically, I am a co-host of some version, but as I said from the outset, anytime the Rhodium and San Francisco Fed ask you to do something with them, sign up, because they're going to do such a great job. You would be embarrassed to even try and help. I think, let me just say with that, the conference has been recorded. It's going to be available for viewing on demand. And thank you all for attending. Thank you very much, and have a good weekend.